If this conflict does remain contained, we think the spillover effects can remain contained as well.
We are seeing a lot of people not doing a lot.
Let the market wash itself out.
The equity market here is actually the wild card.
There's real pain in not being in the market when things revert really quickly just on the blink of an eye.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, wrapping up a brutal first quarter with stocks looking to trim the biggest monthly loss since 2022 as the U.S. is reportedly ready to end the war without reopening the strait. Gasoline prices across America are spiking to $4 per gallon on average for the first time in almost 4 years.
Is it over yet? Is the first quarter over? Is March over? It's been a whipsaw month of pain trades, and people are trying to assess the longer-term damage to the economy, given the fact that this is going on for longer than many people expected. So many different superlatives to describe the month, the quarters so far. One that just keeps coming back is the idea that we've got the biggest monthly gain on record in Brent crude, and that is setting the tone for absolutely everything else.
And heading into April, confusion reigns. The president yesterday reopened the strait, or we're going to escalate the bombing. The Wall Street Journal this morning, we're ready to own the campaign without reopening the strait. So is this strategic ambiguity or just the absence of a strategy?
Either way, the market's taking it as positive, at least if you look at equities, because people maybe are thinking, I can't really understand this completely, as we noted earlier this morning. But coming into this, there is a sense that maybe the president wants to wrap this up in the 4 to 6 week timeline originally framed, which might be a positive because it would end the potential for escalation. There is a bigger question, of course, around the Strait of Hormuz. What happens with the flow of oil? And if you don't get oil prices that come down or even go up further from here, does that really help the markets if there is an escalation?
So some good news, Bramo. The never-ending first quarter is coming to a close. And what a first quarter it's been. Think about everything that's happened. Greenland, Venezuela, Iran, AI disruption and private markets somewhere in between. What a 3-month period we've had to kick off 2026.
Which is why you get the sense that people are benumbed, number one. Number two, looking at a small slice of the market, giving explanations for that and ignoring absolutely everything else. And frankly, a lot of people are not changing their allocations because they say every time we've done that rapidly in response to all of these catalysts, we've been wrong. I know this is dangerous to say. There are more people saying, is this time different, given the prolonged nature of the oil shock and given some of the whipsaw action that we've seen in markets?
Annmarie down in Washington, D.C. this morning. We'll catch up with AMH throughout the morning. Equity futures so far positive by 0.9% on the S&P 500. Coming up this hour, we'll catch up with Sebastien Page of T. Rowe Price with stocks on a 3-day losing streak. Michael Haigh of SocGen on the risk of crude spiking to 150. And Steve Englander of Standard Chartered as Fed Chair Jay Powell attempts to reassure investors. We begin this hour with our top story. The Wall Street Journal reporting President Trump could be willing to end the campaign against Iran without reopening the strait. Bloomberg's Jemana Basechi joins us now from Dubai for more. Jemana, that's 24 hours filled with contradictions.
Yeah, well, John, if you don't mind, I want to go back to the Truth Social post that President Trump put up around 24 hours ago, and I was on your show talking about it, where he explicitly made a link between Iran coming to the table to agree to a deal. He said that they were in discussions with a more reasonable Iranian regime. A deal will probably be reached, after which, if the strait is not immediately open for business, then they would conclude their stay in Iran by obliterating power plants, oil wells, and even Karg Island. So that was directly from President Trump himself about 24 hours ago. Then you fast forward, you get this Wall Street Journal reporting suggesting that he is actually looking to de-link the two, i.e. potentially round up their military operations. They say, and indeed he said this to AMH yesterday, that they are progressing well when it comes to military operations and the success that they've had there, but looking to perhaps resolve the issue of the strait at a later time. Now, clearly, one thing that we need to remind viewers here is that Iran will have a say in this as well. And Iran have effectively been controlling the strait, as we've been talking about. It was only yesterday that they made a move. Their own parliamentary committee passed a bill saying that they will start passing a fee or asking vessels, anyone passing through the strait, to pay a fee for a safe passage. And at the same time, they have also come back to the US's 15-point proposal, if you remember last week, saying that one of their terms is for the international recognition of their sovereignty over that strait. Clearly, this is not acceptable for many nations, including the Gulf Arab nations nearby. And just as a reminder as well as some of the risks that transiting through the strait also poses. Overnight, there was an incident where an Iranian projectile actually targeted a Kuwaiti vessel that was laden with oil off the coast of Dubai. It caused a fire. We found out a couple of hours later that there were no injuries, there was no oil spillage, but again, underscores the risk to some of these vessels looking to pass through. And then finally, the final point of leverage here, if you want to think about the war of the seas is becoming. We've been reporting, per European officials that Bloomberg has spoken to, that Iran is also looking to encourage the Houthis to once again start disrupted shipping on the Red Sea and around Bab el-Mandeb. Clearly, that also would be problematic for the energy industry, given how much of the oil from Saudi Arabia has been routed away from the Persian Gulf towards the Red Sea. And so the question we need to be asking here is, is it feasible to end the war militarily, but still be in a situation where Iran is effectively controlling and determining who has safe passage through the Strait and potentially on the Red Sea as well?
Jumana with the latest, leading our coverage out of the region. Jumana, thank you. Jumana Basechi there out of Dubai. In the near term, and I stress in the near term, I don't think the market really cares who's got control of the Strait of Hormuz so long as the energy is moving. And so long as we see something that gets the energy moving again, risk assets will be encouraged by that. Now, time horizon matters, I stressed, in the near term. In the longer term, that can have its own consequences and complications. I just wonder where we are in all of that right now this morning, even with that report.
And what's the risk premium that people assign to commodities as a result of having to pass through this waterway that's been in contention for, frankly, hundreds of years? I mean, this isn't just a modern phenomenon. There also, of course, is the positive that at least maybe we're going to see an end to the destruction of oil production facilities.
Brent crude this morning, 108, positive on the session by a third of 1%. Here's the view on Wall Street. Sebastien Page of T. Rowe Price writing, this too shall pass, but it could take longer than expected. Stay invested, stay diversified, hedge inflation risk. Sebastien joins us now for more. Seb, the word that jumps out, and welcome to the programme, is stay diversified. They're the words that jump out to me this morning. For decades, people like yourself have built portfolios to withstand demand shocks. The bond ballast provides that hedge for you. Now we see more frequent supply shocks. How do you build that portfolio resilience in this era?
That's a great question, Jonathan. Supply shocks create inflation pressures, and that creates upward pressures on rates. And then, oops, your treasuries are not a hedge anymore. So we're looking through this. When we say stay diversified, we're actually still long the broadening trade. You see it today, some days last week. When you hear about a deal or things getting better, small caps have a tendency to pop on the day. So we're looking through this at a longer, say, 6 to 18-month horizon, staying diversified that way. But I really like the point you made about treasuries. This is the concept of diversifying your hedges. In an inflation shock, in a rate shock, treasuries do not diversify your portfolio. This is not, Jonathan, saying just get rid of your treasuries and buy gold. Because you know what? If we get an actual growth shock, and I love how you've been talking about on the show the slow-moving chain from geopolitics to an oil shock, to inflation, to a rate shock, to a growth shock. It's kind of like a slow-motion crash. Well, if that happens, if the growth shock happens, you'll still be happy to have treasuries in your portfolio. We're looking through this, staying diversified along the broadening trade, diversifying our hedges, treasuries, cash, real asset equities, commodities, and so on.
Let's keep tracking that, Seb. Where do you think we are in the sequencing? From the original energy shock through financial markets to the end game, which ultimately could be, and I stress could be, a rather large growth shock?
I think we're at a point where we're on the knife's edge. Are we going to get the growth shock or not? You know, GDP, Atlanta Fed GDP now is still at 2%. You still have massive AI capex, strong high-end consumer, fiscal pedal to the metal. You still have that in the background. So let's say, Jonathan, let's say we get 2%, maybe even like 2.5% GDP growth. Let's say we get 3.5% inflation, 5.5%, 6% nominal growth. This would be higher growth than any calendar year between the great financial crisis and COVID. higher nominal growth than this entire period. So this is still happening in the background. But there is no doubt that the oil shock, the squeeze on gasoline you were just showing getting to $4, that's a tax on the consumer. The oil shock, the inflation, the chain that you've been describing on the show leads the Fed to maybe eventually hike or at least not cut, and that tightens financial conditions. So it's this knife's edge. Are we going to get the growth shock out of this or reach escape velocity? Things are going to get better. Wall Street Journal is interesting this morning because it's reporting, as you were just saying, that the war could end, but the Strait of Hormuz could stay closed. You know, this too shall pass. This was in my notes. It might last longer than a lot of us expected originally.
Sebastien, you pointed out that back in 2022, the market was beginning to be beset by a series of different shocks, whether it was Ukraine, whether it was the inflation shock, whether it was questions around tariffs. Still, stocks are up to 42% with dividends. A lot of that predicated on what you were just talking about, the fiscal and the monetary stimulus. How different is this time, given that some of the pillars are in question? How much more fiscal, whether monetary stimulus is going to come into play, and whether AI CapEx is going to be challenged by these higher rates?
Let's call it the growth knife's edge. That's where we are in Jonathan's chain of event here, starting with geopolitics. If you travel back to January 2022, and let's say as a thought experiment, you decided to short the market, and you fell into a coma, and I'm waking you up, and you ask me what happened to the markets, Lisa, and I go, Russia invaded Ukraine. We had 9% CPI year-over-year inflation. The Fed hiked by 550 basis points. We had the number 2, number 3, number 4 biggest bank failures in history. Oh, we had the highest tariff rates of all time. And by the way, there's a massive war and an oil shock right now in the Middle East. And you wake up from your coma, you shorted in 22, and you ask me, is the market down? And I go, no, it's actually up 42% cumulative with dividends. This is a function of 20 trillion of COVID stimulus, addiction to fiscal stimulus, which might not end well, but it's pedal to the metal for now. Very strong high-end consumer and wealth effect, and of course, the massive wave of AI CapEx. I'm reasonably optimistic when it comes down to it. With 5-6% nominal growth, we don't know how long the oil shock will last. The average of the 7 last oil shocks, oil peaked at 23 days, and it peaked at like plus 27%. We're at day 30, and we're already up 40-50%. So this too shall pass. I think it pays to be diversified, even between stocks and bonds. We don't want in our asset allocation committee to just de-risk completely right now. Stay neutral stocks, bonds, diversify the hedges, and then look through this with the broadening trade.
Just quickly, Sebastien, how much has consumer or retail buyers sentiment changed as a result of all of these shocks and all of this volatility? You know, we talk a lot about retail buyers and their influence on markets, on liquidity, on prices. And retail buyers, you know, they've done quite well as investors, especially buying the dips over the last few years. Back to the COVID era, millions of brokerage accounts were opened. Now, I think there's a bit of a whipsaw on this cohort of investors, but I have learned to never underestimate retail investors. They do provide liquidity to markets. That's what makes a market. And you know what, Lisa? I think we were talking last time I was on the show whether markets are investable or not. The VIX, remarkably, the VIX is just like peaked over 30 for the first time, and it's down below 30 today. So things are okay with liquidity and trading in the markets, Lisa.
Hey, Seb, it's good to see you. Thanks for dropping by. Sebastien Page there of T. Rowe Price on the markets. I have to say, I'd ask a different question. After all those things that have happened, I wouldn't be asking if we're down. I'd be asking how much we're down by. 10, 20, 30, 40, 50%. We've thrown a lot at this market, and this market has been very resilient.
And right now, a lot of people are not capitulating or getting out of risk because they've been trained by previous experience. How much is that actually contributing to the resilience that we're seeing in certain pockets of equities today?
Equity futures on the S&P positive by 0.9% with an update on stories worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Good morning, John. President Trump is ramping up threats on Iran even as he considers his options. The Wall Street Journal reporting the president told aides he's willing to end the U.S. campaign even if the Strait of Hormuz remains largely closed. The report says the concern is that a mission to open the choke point could extend the conflict beyond the timeline. An Iranian drone struck a fully loaded Kuwaiti oil tanker docked in Dubai early this morning. The vessel was in an area packed with ships waiting to leave the Persian Gulf. The strike damaged the hull and started a fire, but no oil was lost and all 24 crew members are safe. And Secretary of State Marco Rubio says the U.S. may need to reassess its relationship with NATO after the Iran war is finished. Speaking to Al Jazeera, Rubio criticized what he sees as a lack of support for U.S. operations in the Middle East from NATO member countries. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. More from Yahara later this hour. Up next on the programme, building pressure for a deal.
Despite all of the public posturing you hear from the regime and false reporting, talks are continuing and going well. This is another historic opportunity for Iran to come to a deal with this president and the administration.
Up next, we'll catch up with Norman Roule of CSIS, live from New York City this morning. Good morning. The longest first quarter ever coming to a close. One more day to go. Equity futures right now in the S&P 500 bouncing positive by 0.8%. The Nasdaq up by 0.75%. Some encouragement in a Wall Street Journal piece that the president would be willing to end this war, even leaving the Strait of Hormuz up to Iran and maybe allies to sort out in the future, which would be amazing because the Treasury Secretary said just, 24 hours ago that we would reopen the strait and the U.S. would gradually take control.
As you said, mixed messaging across the board, a lot of contradictory signals, whether it's going to be escalation if there isn't some sort of deal, or whether it's going to be, I'm going to walk away because we're reaching our 4 to 6 week target and we've destroyed a lot of the Navy. How much of the move that we're seeing this morning is also driven by Fed Chair Jay Powell, who didn't come out saying, we're looking at inflation, we're going to raise rates. Instead, he said, we're in a good place. And everyone said, oh, yay, we don't have to really factor that in.
And a 9% decline off the highs of the year so far in the S&P 500 that many people on Wall Street are itching to buy. Under surveillance this morning, building pressure for a deal.
The United States is conducting more intense, targeted strikes with devastating combat power with each passing day. Despite all of the public posturing you hear from the regime and false reporting, talks are continuing and going well. This is another historic opportunity for Iran to do the right thing, to rid themselves of their nuclear ambitions and to come to a deal with this president and the administration. Or again, they will see the grave consequences of the United States Armed Forces.
So here's the latest this morning. The president reportedly weighing ending the war in Iran without reopening the Strait of Hormuz. The Wall Street Journal reporting the president telling aides the U.S. could wind down hostilities while keeping up the pressure on Tehran. Annmarie joins us now from Washington for more. Good morning, Annmarie.
Good morning, John. And as you and Lisa have been talking about, is this mixed messaging? It feels very inconsistent just on the heels of what the president put out on his social media account yesterday, talking about how if a deal is not struck quickly, if the Strait of Hormuz is not reopened for business as usual, then he would go after electrical and oil installations in the country. To really understand what is going on right now in terms of the war in Iran, we're pleased to be joined by Norman Roule, former senior U.S. intelligence official. Norman, thank you so much for joining us once again. We want to begin with that Wall Street Journal reporting overnight. The president is considering winding down the military operation, even if the Strait of Hormuz remains largely closed, or I guess controlled by the Iranian regime. Is this inconsistent to what he's been saying, or do you see this maybe as just the next phase of this conflict?
Good morning. I would look at this as part of the overall rhetoric of the campaign. We've got to keep in mind that we still have U.S. forces flowing into the region. There is no sense of a diplomatic rift between the United States and its Gulf allies. Talks are still ongoing between the United States and the Iranians, and you'll want to keep pressure on the Iranians in those talks. This statement is probably part of the overall tactical approach to those talks, in which he's trying to keep the Iranians off balance and ensure that they don't have too much of a heavy hand on the talks, letting them know that he's not placing so much strategic importance on the Strait of Hormuz for the United States. But in general, the president's approach is going to want to maintain pressure on the Iranians in the near term, as we saw with military attacks on the Iranians last night, which were severe.
Oman is slated to help in terms of this legal framework that the Iranian parliament is working on to collect a toll. Is the Gulf divided when it comes to this issue?
I don't think so. I think the Gulf will be somewhat united on this issue. They're not going to let the Iranians have a chokehold on their flow of goods. Now, let's keep in mind what this would mean. The proposed Iranian law, which is not yet approved, would in essence allow Iran to decide which ships would enter the Strait of Hormuz and to acquire a toll. Now, that would mean not only that Iran could decide which countries could then send ships into the Gulf to deliver goods to countries. That would include food as well as goods. But in theory, the Iranian parliament in the future could then say which countries could then supply those goods. So imagine the Iranian parliament one day saying that they would like to ensure that the U.S. or other countries aren't the suppliers of food or goods to Gulf countries. No Gulf country would tolerate that. So this is early stages for this. It's a negotiating point as well. Gulf countries would not accept this position.
The Associated Press is also reporting that a number of Gulf countries led by Saudi Arabia, the UAE, want this to be finished in terms of military operation or to see serious changes when it comes to the regime. Are we there yet? Do you think there's been enough of changes within the leadership?
No, their leadership remains united. It's consistent in its hardline approach with the pre-regime leadership. However, that leadership is under military pressure, even lethal pressure from Israeli actions, and the leadership could change in the near future. But at the same time, the negotiations are continuing, and the Trump administration's approach is that if they were to concede, which is very unlikely, that sanctions relief could occur, and the conflict would come to an end, which is what everyone seeks, to include the Gulf states.
Norm, do you have an idea of who exactly the United States is negotiating with in Tehran?
We're negotiating with a fabric of officials. These officials have a common worldview, which has been set by their experiences since 2003. They all have a similar generational viewpoint of how Iran should approach the international community and its future. They're hardliners. They've experienced life since the Iran-Iraq War. They have a general experience of support for the Revolutionary Guard. They believe they can defy the international community successfully, defy the United States, and that Iran should be the regional hegemon.
Norman Roule, thank you so much for your time this morning. Of course, that was Norm Roule, former senior U.S. intelligence official. Jonathan, that last point there, the fabric of the regime still is intact, and that is who the United States is dealing with right now. As we see some of this mixed messaging coming from the White House, as the president has vacillated between what exactly he wants to see when it comes to the Strait of Hormuz, and even different messaging, if the Wall Street Journal is correct, from what we heard just yesterday from his Treasury Secretary.
It's difficult to keep up with what's been happening, not just over the last month, but particularly the last 24 hours. Annmarie, thank you. Down in Washington, D.C. so far this morning. Negotiations, we're told, are ongoing. We'll see if they bear fruit. The contradiction of the last 24 hours, and we've covered it repeatedly now in the last 25 minutes, the president said one thing yesterday, which ultimately is reopen the Strait of Hormuz or re-escalate things big time and go after your power plants and energy infrastructure, things that would harm civilians. And then in the Wall Street Journal this morning, willing to walk away without reopening the Strait of Hormuz. Which one is it? And markets have been struggling with this now for 1 month. And I imagine they'll keep struggling with it for the time being.
And there are two takeaways from this. One takeaway is it's unclear if there is a strategy that is going to be implemented that people can follow. And that has been one issue that people have had. So in other words, do we have clarity on that? And number two, a question of how vulnerable is this president to the market? How much is the president paying attention?
The efficacy of the Trump put in question this month. Up next on the programme, Michael Haigh of SocGen on how crude could top 150. Plus, your has got your morning movers. Dip buyers pushing the Mag 7 higher. Some of those names have had a really rough ride through the month of March. From New York City, you're watching Bloomberg TV. Here's a question for the next pub quiz. What did the S&P 500 do in the month of April 2025? What was the 1 month performance? Would you have guessed it was down just 0.75% following Liberation Day at the start of the month? That sell-off was short and sharp, and it was bought aggressively when the president backed away. This month is very, very different. This month is one of the worst months we've seen in the equity market worldwide, going back to the energy shock of 22 and the rate shock of 22 in this country, going back to the pandemic of 20 and GFC in 2008. I'll go through the numbers point by point. On the S&P, down almost 8%, worst month since 22. Euro Stoxx 50, worst month since 2020. Nikkei, worst month since 2008, and likewise for the Kospi in South Korea.
So is this a growth shock? Is this potentially some areas that are getting hit harder? We know that Europe and Asian nations are being more significantly affected by higher oil prices and the shipments specifically from this region. There's another element, though, to this, and I'm talking about the Kospi and the Nikkei, which is some of the high-flying momentum stocks and momentum trades more generally have gotten completely undercut and whipsawed, particularly with semiconductors. When you look at the Kospi, how much is that behind the biggest move since 2008?
Japan and South Korea have had a really, really tough month of March. Heading into April, will these losses be bought? Equity futures bounced this morning on the S&P, the Nasdaq, the Russell. Check it out. Futures up by 0.8%. On the Russell, outperformance up by more than 1%. The Journal is where our focus is this morning. The Wall Street Journal reporting that the President of the United States is willing to walk away from this campaign against Iran, even if the Strait of Hormuz remains largely closed, which is in conflict to anything we heard yesterday from anyone in the administration, including the president himself.
So is this move this morning on the margins a result of that reporting, the idea that there could be de-escalation even with an outcome that is not ideal for a lot of different players? There is also a feeling that people, as you were mentioning before, are so eager to buy this dip that they are coming into this because of the experience of 2022, because of that 42% gain that Sebastien Page was talking about. So there has been this sort of knee-jerk feeling, and you've seen it in the reports from Morgan Stanley and from Goldman Sachs. Maybe it's getting to be a good time to buy.
Stay invested. Stay invested. Earnings are good. How many times have we heard those things on this program over the last few weeks or so? The fear of missing out is still greater than the fear of losses. And I don't think we've had that massive sentiment washout like those other periods we described, the pandemic back in 2020 and, of course, GFC many decades ago now.
The difference is that in all of those scenarios, there was a policy response. When you've always said when policymakers panic, that's when the market can start feeling better. Are they panicking? Maybe that partly was the response to that headline from the Wall Street Journal. Is there some sort of capitulation in response to the market moves, or is this just confusing messages that we've seen for the past couple of weeks?
So we turn to the bond market and get to the message from the Federal Reserve. 2s, 10s, 30s, yields just a little bit lower. 10s down to 433. We've got 2s down to 380. Bear in mind that in the last week, we have seen 2s north of 4% briefly. This from the chair, Jay Powell, over at the Federal Reserve. We think our policy is a good place for us to wait and see, and really stressing that he believes inflation expectations are well anchored here.
And saying ultimately the one reason why they would respond is if longer-term inflation expectations ticked up. I don't think they're looking at the University of Michigan sentiment survey as much as maybe five-year forward break-evens, which are now at the lowest levels of the year. So if they're looking at some of those forward indicators, not screaming a long-term inflationary
Do you remember when you, Mitch, was the difference between just a rate hike and a jumbo rate hike at the Federal Reserve?
I do remember that. That's a reason why maybe it's interesting that this time around it won't be as relevant.
That was quite a ride, wasn't it? Let's get to crude. Every single morning, the first thing you look for, Brent, WTI, where's it trading? Yesterday, WTI trading in triple digits, closing in triple digits for the first time since this war began. WTI up again this morning, 104.55. Brent crude, Lisa stressed this a few times, the biggest one-month move on record for Brent crude. We're talking about a rally of more than 50% through the month of March.
Yeah, and if you compare that to the Gulf War in 1990, it was about 46%, so it exceeds that level. What I find interesting is you're starting to see WTI come up to meet Brent, that gap between the two starting to close, highlighting how global this market really is.
Not so long ago, early this month, that gap was pushing $20. Brent and WTI. That story's changed. As we count you down to the opening bout, 3 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Big tech helping to lift this market this morning as hopes grow that the Iran war could de-escalate based on that Wall Street Journal report. The war had been hitting that tech trade hard. We saw Microsoft down 10% in the month of March alone, due, of course, to higher energy costs, but also the risk that key funding from the Middle East could be disrupted amid a drawn-out war. So we are seeing a bit of a relief rally this morning, with Meta up 1.5%, Microsoft also up 1.5%. Turning to some possible deal news, we are seeing shares of McCormick up 4.4% in the pre-market as it gets closer to buying most of Unilever's food units. Now, this isn't a clean sale. Unilever will still own a majority stake, with McCormick running the business. That will let Unilever focus on growth areas like beauty and personal products. A deal could be announced as soon as today. And with all the talk around space and the Artemis 2 launch, I want to point to Virgin Galactic. Shares are up nearly 6.5% in the pre-market after the company put up new space flight tickets up for sale for $750,000. That's $100,000 more than before, suggesting that demand is holding up for space tourism, overshadowing what was otherwise a tough earnings report, with losses continuing to mount for this company. John?
Yeah, Harry, thank you. I'm obviously not the target audience for that. $750,000, somewhere nice by the water in the south of Europe, right? Retirement place.
I don't picture you with a space bubble around your head.
If I don't want to go on a cruise, it's unlikely I want to be stuck in one of those things, isn't it?
What if they've got Mickey Mouse and a big slide?
It would make it even worse. Big slide to wear, Bramo.
Well, you know, we can watch space movies and dream away.
Let's move on. On our radar this morning, President Trump could be looking for an off-ramp to end the war with Iran, according to the Wall Street Journal. Trump telling Gates he's willing to end the US military campaign without reopening the Strait of Hormuz. Elsewhere, Iran escalating attacks on energy sites, hitting a fully loaded Kuwaiti oil tanker near Dubai in drone strikes early this morning. The vessel docked in an area with other ships waiting to exit the Persian Gulf. And finally, the White House press secretary, Karoline Leavitt, saying President Trump would consider seeking and asking Arab nations to cover the costs of the war with Iran.
I think it's something the president would be quite interested in calling them to do. I won't get ahead of him on that, but certainly it's an idea that I know that he has, and something that I think you'll hear more from him on.
The president insisting talks with Tehran are going well and suggesting a regime change is complete.
You know, these are ongoing mixed messages, and I would like to hear something from Saudi Arabia and UAE, which has been negotiating with the United States, but quietly. We've seen also other reports that Saudi Arabia is really pressuring this administration, the U.S., to keep going until the Iranian regime is more significantly deterred, because otherwise it is a huge operational risk for them with respect to their exports. Also, a question of how much they are willing to get on board to start engaging more significantly. I keep taking the signal, though. This is a concern about the cost. We've heard about the concern about the length. It's responding to all of the criticisms coming from his own party that President Trump is dealing with, and how he's trying to respond to them.
WTI crude this morning, 105, Brent around 108. We're holding above triple digits as Iran still maintains control of the Strait of Hormuz. Michael Haigh of SocGen writing, we expect Brent to average 125 in April, with credible spikes towards 150. Michael joins us now for more. Michael, welcome back to the programme. Since we last spoke, what's changed for you? What's led to this?
Well, we've got more mixed messages, of course. What's changed is the fact that we have to deal with creating more and more scenarios on the eventual outcome of this conflict. So the numbers you're talking about there is a situation where we get some sort of opening by the end of April. But unfortunately, and the reason why we have such elevated forecasts is because it's going to take a long time to normalize. And one of the strongest relationships you have to the price of crude oil is the level of inventories. And they are coming down dramatically as the Gulf oil can't find its way out. You see stories of countries making big adjustments.
Michael, how much would prices go down if the conflict stopped, if there was no more bombing, if there was no more destruction of oil facilities, but the Strait of Hormuz remained squarely in the control of Iran?
Well, it would come down with some sort of de-escalation, of course. But as I mentioned, it wouldn't just fall back to where we were before the conflict began. I mean, in December, before we started hearing the threats, there was no risk premium in the market. It was very fundamentally driven. And as you mentioned earlier on in the show, we've seen about a 50% increase in the price of crude, some of that risk premium and some of it fundamentally justified. It would take a long time for it to come down. So our expectation is that it would trickle down potentially by the end of the year. The issue, of course, is that inventories are very, very low. OPEC would try and bring back some more oil into the market. And then you run the risk, if something else happened between now and the end of the year, we don't have that buffer.
How much would prices, on the other hand, spike if, say, the Houthis got more significantly involved, as some reporting has indicated, and the Bab el-Mandeb Strait was pushed away, or at least put under attack, similar to what we have seen in the past few years?
Yeah, well, that's what we call Scenario C, where we have the conflict continuing through April and into May, and one of the assumptions is that there's an escalation in order to de-escalate, and so the proxies get more and more involved. And if we add on to our scenario a 2-week closure of the Red Sea, so that's 14 days times 5 million barrels, you add that on top of the 800 million barrels that you've lost from inventory because of the closure of the Straits of Hormuz, you add all that together, you put it through an inventory price model, and that's what gets you above 200.
I don't know, Michael, if you've seen that letter that was revealed by Politico on Europe, that Europeans should consider travelling less to avoid energy shortages, a recommendation by the EU energy chief. We've been tracking the shortages through Asia, individual markets. I know you've been doing the same thing. I've been reading your research. Where are we with that? And when does that arrive on the shores of Europe?
Well, I'll just give you one example. So the final vessel carrying jet fuel into the United Kingdom is going to get here in 48 hours, and there's no more after that. So Asia's already feeling the crunch. You've heard Spain and other countries lifting excise duties on gasoline and diesel. So it's starting to come here now.
Michael, I'm going to use the word panic, and you can push back if you like, but this is relatively speaking. Do you sense that there's more panic in your asset class because of the things that you're following more closely than maybe you're witnessing and feeling in other departments, other asset classes elsewhere?
Yes, actually, short answer is yes. The equity markets, guys, don't seem to be overly concerned about this right now. I've been warning them that once you start hearing more and more stories about the fragility of some economies and huge demand destruction, because it's not so much that people can't afford to buy the energy, they can't get it. I think you're going to see a lot more spillover.
Michael, how close are we to the Jimmy Carter moment for Europe? The wear a sweater, don't travel, sit in your home, don't heat it, don't cool it. I mean, how close are we to actual physical shortages, creating policy that crimps people's living styles?
I think we're weeks away from that. I mean, you've heard these policies that you've just mentioned in Asia: stay at home, work at home, use less fuel, etc., etc. It's not there yet. As I mentioned, we have one last jet fuel carrier coming into the United Kingdom. Not sure how long that would last for the airlines, but I would give it probably by the end of April. We would be talking a different story here.
Well, Michael, thanks for the update. We'll keep talking. And thanks for the research as well. Michael Haigh there of SocGen, not just on the forecast for prices, but the forecast for shortages. The wording, the language in that particular response is so important. It's not about whether you can afford it. It's about whether you can find it. It's about actual, real, legitimate shortages that we could be talking about across Europe and not just Asia.
And we've heard already about actual physical shortages in Asia, where people are driving around trying to find extra canisters, liters of petrol. At what point does that start instituting policies that crimp growth in a pandemic-type scenario, which is something that we keep hearing?
Brent Crude, 108. Equities fading just a touch. We're still positive here by 0.6 on the S&P with an update on stories worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Iran is pushing the Houthis to prepare for a renewed campaign against Red Sea shipping. The move would be contingent on further U.S. escalation of the war. Leaders of the Yemen-based militant group are weighing options after launching ballistic missiles at Israel. Italy is denying U.S. aircraft bound for the Middle East permission to land at a base in Sicily. Sources in the country reporting the U.S. submitted a flight plan to Italy without authorization from national authorities. It follows a similar move from Spain yesterday. And U.S. gas prices have officially topped $4 a gallon for the first time since 2022. The nationwide average retail price for regular unleaded gas rose to almost $4.02 a gallon. That's more than $1 since the start of the war with Iran. That's your Bloomberg brief, John.
Yahara, thank you. Thanks for the latest. More from Yahara in the next hour. Up next on the programme, looking through the oil price shock.
By the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone. Inflation expectations do appear to be well anchored beyond the short term.
A statement from the chairman of the Federal Reserve provided this market with just a little bit of comfort in the last 24 hours. Up next, Steve Englander of Standard Chartered from New York City. You're watching Bloomberg TV. Equities bouncing here up by 0.6%, following a three-day slide on the S&P 500, heading in towards the end of this month and heading towards the month of April. Thank goodness for that. On the Nasdaq 100 up by 0.5%, on the Russell up by 1 percentage point. In the bond market, some comfort. As Chairman Powell put a floor in this bond market, a lid on bond yields. Your 2-year, 383, 10s, 433. Under surveillance this morning, looking through the oil price shock.
By the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone.
The FOMC is and will continue to be committed to getting inflation back to 2%.
Inflation expectations do appear to be well anchored beyond the short term, but nonetheless, it's something as we will eventually maybe face the question of what to do here.
So here's the latest this morning. Fed Chair Jay Powell telling investors the FOMC can wait through rising energy prices. Steve Englander of Standard Chartered writing, fundamentals suggest a less dramatic impact from the oil price spike than previous episodes. Less economic reliance on energy also bolsters the case for overall growth to withstand the shock. Steve joins us now for more. Steve, good morning.
Hey, good morning.
Why will this Fed chair, in your words, choose to aggressively do nothing?
Because he doesn't know what's going to happen. And, nobody knows what the dominant effect is going to be, whether it's a slower economy or higher inflation. You don't know the timetable. There are just so many unknowns. There's no reason to commit in one direction or the other.
He's not committing. Do you have a base case?
Well, we have it flat through, through 2026.
So no rate cuts?
No rate cuts and no rate hikes. This seems to be like a good level.
Is that the same response that you expect from the ECB, or is it a different picture as we see inflation metrics tick up to the highest in almost a year and a half?
Well, ECB is talking tough. I mean, I think that they worry more about credibility, and you can look at inflation swaps in Europe that picked up a lot more than they did in the U.S. But at the end of the day, we think that they're not going to hike as much as the markets are pricing right now.
How much is this because people are looking at the idea of this being a disinflationary shock? And how realistic is it to consider that if the economy was so strong heading into this? And I'm not talking about Europe as much as the U.S.
Well, cards on the table. I'm not going to my boss and asking him for a pay increase because
Steve, we need
it's more expensive.
I think you've had a great 3 months.
Thank you very much.
But to talk about this.
Well, you talk to my boss then.
I will.
But I think everybody is like this, right? Nobody is asking for a pay increase. Nobody wants to risk their jobs. Unlike, say, 2022, when we had the oil shock and you could wave your hands on the street and get a higher paying job. Yeah, I think now people are really concerned. So I think where we're going to see the hit is most likely on consumption.
Given the fact that you believe that the U.S. economy was quite strong going into this, how much do you think that it can withstand not only the oil price shock, but also potentially some restraint on fiscal spending, as well as a Fed that's not moving off the sidelines?
Sorry, what restraint on fiscal spending are we discussing here?
Okay, fair point. But at least, there isn't an obvious expansion of some of the fiscal benefits.
I think even if the war stopped tomorrow, there's so much rearmament that's going to go on. I doubt that. I wouldn't want to be lowballing deficits looking ahead. What would the first question?
Just how much, just in terms of the oil shock, and how much that would be a hit to growth that could potentially turn this from something that is more negative?
Look, we think that the shock is going to be, mostly on demand more than on prices. What we do worry about is you get beyond a certain point. It's not like oil prices are going up because Japan is booming and China is booming and there's global demand and you just have to adjust to higher oil prices. they also proxy for the possibility that there are going to be shortages of, not just crude and crude energy products, but, refined products and so on. So there's an element here that say, we can deal with oil or Brent at 110 to 115. If it goes to 125 or 140, it may also be telling us that the degree of disruption, we're back to COVID-style supply-side disruption, which does have a heavier inflation impact.
Steve, this feels like a slow-moving train crash. Whenever we speak to anyone in commodities, and I'm sure you feel and have the same experience, they are panicked. And I think you can use the P word. I was hesitant about using it earlier, but Michael Haigh certainly didn't push back over at SocGen. They feel stressed and panicked about what they can see several weeks out, because they can see what's not going to arrive into Asia, what's not going to arrive into Europe, that would usually arrive, which is jet fuel, crude. The refiners aren't going to get the oil they usually receive. They can see all of this lining up, and then we have this comfort in the stock market that somehow earnings are insulated because companies are doing well. But Michael Haigh's point is an important one. This is not about the price we can afford to pay. It's about the shortage of the goods, the absence of them. They just won't be there. Do you sense the panic in their asset class, and why do you feel a little bit more comfortable with it?
Well, look, there's always an element that you can over-panic, right? In the sense that, I'll take my vacation in the Adirondacks, not in Asia, this year. So less jet fuel being consumed. I think that what we look at is where oil is priced to be at the end of the year. It's still priced under 85. That tells us that there's some risk there, that if the war continues and if there is disruption, even if the first contract doesn't go up, if what you see is that everything else begins to catch up to it, that over 100 becomes the norm, that has a lot of implications. It's actually dollar positive, not for a good reason, but it's, in terms of economic disruption and in the places you mentioned, it probably becomes much more severe.
Steve, it's good to see you. Thanks for being here.
Pleasure.
Thank you, sir.
Thank you.
Steve England there of Standard Chartered on the backdrop for this economy right now and the shortages that we're already seeing take place in places like Asia and the ripple through you might see in the weeks to come.
When you say the P word, you could say panic or you could say pandemic. And we keep talking about that and we keep hearing that, the sort of pandemic era closures, shut-ins as a result of, at that time, a mandated isolation. At this point, just a lack of physical goods that people normally rely on to get around. I keep thinking about the policy response. How much fiscal room do governments have to really flood this market with cash like they did during the pandemic?
I don't think you should throw around the P word in financial markets, panic, which is why I'm hesitant about using it. But I don't think I would be doing my job if I didn't accurately describe what I think people in commodity markets are feeling right now and stressing. As I say, I put that to Michael Haigh of SocGen just moments ago, and he certainly did not push back. There is a sense of panic in their community about what they're seeing materialize.
Jeff Curry certainly seemed as though he was getting emotional about this, and he's not alone. They're seeing the potential for escalation, and it's with the Houthis getting involved, it's with the destruction of inventories, it's with a question of supplies, and they put this all together and they see what's happening in Southeast Asia, they see what's happening in places and pockets in Europe, and they say, this is going to get a whole lot worse potentially the longer it goes on.
We cover financial markets. This is your judgment call. You get to decide whether that panic is misplaced or not, and invest accordingly. Coming up on the programme, we'll catch up with Lisa Shallot of Morgan Stanley, Libby Cantrill of Pimco, the former White House senior advisor Amos Hochstein, and Christina Campmany of Invesco. The second hour of Bloomberg Surveillance just around the corner.
If this conflict does remain contained, we think the spillover effects can remain contained as well.
We are seeing a lot of people not doing a lot.
Let the market wash itself out.
The equity market here is actually the wild card.
There's real pain in not being in the market when things revert really quickly just on the blink of an eye.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equity futures positive by 0.75% on the S&P following the biggest one-month slide going back to 2022. Can we trim some of that? On the Nasdaq, higher by 0.6. On the Russell, outperforming, up by 1.2%. In the commodity market, Lisa's talked about it repeatedly throughout this morning. We've had a rally this month of more than 50% on Brent crude, and we are looking to add to the biggest monthly rally on record. This from the president, according to the Wall Street Journal. The president telling aides he's willing to end the U.S. military campaign against Iran, even if the Strait of Hormuz remains largely closed. That's setting the tone for this morning.
Yeah, and it's a mixed message compared to what we heard yesterday from a Truth Social post, speculating on some escalation should there not be some sort of deal struck. Is this a tradable market? We keep saying that again and again. Is this a tradable market when you are trading off of truths and reports that are giving some conflicting signals? And right now, it is tradable in that it is being whipsawed. It is getting your face ripped off. It is having momentum trades that are completely getting unwound. And it has been an incredibly painful, the pain trade march that nobody wanted.
This is a market full of contradictions. We've had a big correction in price. We're down by 8-9% so far this month. Yet earnings expectations have got better, not worse, for companies on the S&P 500. That's something we might have to reconcile in the weeks to come.
Is this just backward looking, given the fact that a lot of companies are looking at the momentum of the consumer heading into this? Is this not necessarily realistic based on the price shock? Or is this that there are a number of companies that are benefiting from this, right? I mean, this is something that our next guest, I know, has talked a lot about, the idea of defense spending and commodities, and how in the United States, in a very bifurcated or diversified market, you have benefits from all of those things. If we're going to start spending trillions of dollars in defense, well, hey, guess what? Guess there's some companies that are going to benefit.
Let's spend some time on tech this hour as well. The correction we've seen in some of these names, Meta down 17% this month, Alphabet down 12% this month, Microsoft down 9% this month. The problems in some of those names predated this war. And I think you have to isolate and zoom in what's happening with technology stocks as well. Even if this war ends, what happens with those names?
I frankly don't totally understand this. I mean, Meta, I understand a little bit from the lawsuit and the questions around whether this is their tobacco moment. With Microsoft, some disruption from AI. The semiconductors, though, and the memory chip stocks, which have seen their worst month so far going back to 2005. How do you justify this? Is it a lack of CapEx spending that can be justified by where borrowing costs are? Or is this potentially just a complete unwind of a momentum trade? Because otherwise, we were talking about memory shortages. It was a shortage problem. So if that is sort of a demand issue suddenly because of CapEx spending, well, they have then the supplies to meet that. I'm just trying to wrap my head around this.
That was the start of the quarter, Bramo.
I'm sorry. Excuse me. I'm a bit scrambled this
morning. That was when the Kospi was absolutely flying.
I can't keep track.
And the Kospi was turned upside down, down 19% so far this month. Coming up this hour, we'll catch up with Lisa Shallot of Morgan Stanley as equities bounce, Libby Cantrill of Pimco on a potential Iran war off-ramp, and the former White House senior advisor Amos Hochstein as Tehran squeezes the Strait of Hormuz. We begin this hour with stocks looking to snap a three-day losing streak and crude adding to its biggest one-month rally on record. Lisa Shallot of Morgan Stanley writing, investor confidence largely rests on continued conviction in the bull case, positive earnings revisions and a belief that impacts of the war will be short-lived. Lisa joins us now for more. Lisa, good morning.
Good morning.
What a strange month. This big correction in price we've seen in certain equity markets, and yet the outlook for earnings is better, not worse.
Yes.
How do you think we reconcile those two things in the months to come?
Well, I think that what we're looking at right now from our analysis is a bit idiosyncratic. To Lisa's point, when you actually decompose that earnings revisions, it's basically coming from energy stocks, which are benefiting from price, and the tech stocks, right? Even though those tech stocks are the ones that are being sold off, right? And I think that the story around tech is fundamentally a story of revaluation. Is as more and more CapEx goes into the ground, these guys are getting more and more capital intensive. Folks are worried about negative free cash flow. They're worried about return on investment, and we're pressing down some of these multiples. Now, from where I sit, it's probably excessive, right? Some of these unwinds have been, I believe, technical and mechanical. So for me, as a fundamental analyst, I'm looking at potential entry points in some of these tech stocks because, to your point, the fundamentals are quite good.
Would that be the hyperscalers? Would that be the chip players?
It would be much more the hyperscalers. I think the chip guys have some ways to go to catch up. I think fundamentally we have to remember semiconductors are cyclicals. They are very, very cyclical. And I think while you got shortages now, you won't have shortages forever.
How much do you think that the capital expenditures are going to get constrained by borrowing costs that are on the margins higher? And frankly, a lot of investors, for both the reasons having to do with the war and private credit, that are much more reluctant to lend at decent levels.
Yeah, I don't think, look, the hyperscalers have among the best balance sheets out there, even if their free cash flow growth has gone negative. So I don't think that's what's going on. I think what's going on is an overall cost of capital issue in the market, but I don't think we're going to see CapEx slow down anytime soon.
How much do you think, just in general, this broadening out trade or the idea of a whole market rally is constrained by what we're seeing, which is a wholesale credit condition tightening across a myriad of different indicators?
Yeah, so I think this is what the market finally began to sniff out on Friday and yesterday, which is it's one thing to put the inflation trade on, but it's quite another to start thinking about downgrading demand. Right, and saying, look, financial conditions are now across the broader swath of the economy, tightening so much that we're going to have an impact to growth. So we at Morgan Stanley took our GDP numbers down from a 2% real growth to 1.7% real growth. The reason that is so important is that 30 basis points basically takes out half of your benefit that everyone was forecasting for fiscal stimulus. So it takes out half. This goes on another 2 months. You're going to take out that other half, and it's as if that tax cut and big, beautiful bill didn't even happen.
It becomes so bad it's good for bonds?
Yes, absolutely. It's look what you had yesterday. You had a rally, across the curve about 9 bips.
We're going to see more to come across the yield curve, particularly an opportunity to take on duration?
So I think it's too soon to take on duration. We're watching it. I think if you are a day trader, I think there's money to be made in trading bonds. I would not, as a long-term investor, be buying duration quite yet.
When you have investors, clients call you, they've got billions of dollars, millions of dollars. They're trying to figure out how much they should pay attention to this, how much this time is different versus, say, 2022. What do you tell them?
So, look, I think the dynamics are certainly different. We had a real earnings recession in tech alongside rising rates in 2022. We don't have rising rates. We have tightening financial conditions, and that's different because it can cure more quickly. And as we said, tech earnings are actually expanding and they're resilient. So I do think that this is fundamentally different, and the degree to which you still do have these tailwinds of stimulus potentially behind you is helpful. So I do think that this market can be more resilient than it was in 2022, which was a policy shock, right? That was the Fed coming in and raising rates against, slowing momentum in tech earnings. So this is different, but I think it's scary different. And so the scary part is there's so many things here that are not policy driven. They are geopolitical. And I think one of the things that every day that this goes by, it's becoming clearer and clearer that the United States president does not have singular control. He doesn't have the only cards to play.
At what point do you have to start gaming out oil prices that stay around $100 a barrel or even higher for a prolonged period of time, especially because the Strait of Hormuz is becoming an intractable issue that's sort of unclear exactly how it can resolve?
Yeah, so right now we're saying that, if this were to end tomorrow, normalized oil prices go back to kind of 80 to 90. That's up from where we were, which was 65 to 75. Another 2 to 3 weeks, we're going to be in that 100 zone.
Just going through everything you've said in the last 10 minutes, let's try and put it together. Question the efficacy of the Trump put. The Fed doesn't really have a role to play quite yet.
Correct.
And you're seeing a structural shift in the appropriate multiple to put on tech stocks. The premium valuation the US equities had versus the rest of the world, has that gone?
It's starting to go. It's starting to erode. It's starting to. I think it's got, in aggregate, it's got more to go. I don't know that the multiple on Microsoft's got much more to go, or the multiple on Blackstone. some of these stocks are down, significant amounts, but the market as a whole probably, still has some mean reversion to the rest of the world.
Can you describe what that might look like in the next few years as people look to take regional geographic diversification in mind and shift away from the US and maybe buy more of other places?
Yeah, I mean, I think it's about a much more balanced portfolio, right? We got to the point at the beginning of last year where, U.S. equities as a share of the total global equity market cap, had breached kind of 62%. I mean, that's extraordinary. I mean, the last, 15, 20 years, it's been around 55. So, I think it does mean that rest of world attracts capital. And we see much more global portfolios participating here.
Lisa, thoughtful stuff. It's good to see you.
Yes,
thanks for dropping by. Thank you.
Thanks.
Lisa Shallot there of Morgan Stanley on a very complicated equity market.
I wonder how hard it is to sell the story of diversification outside of the U.S. at a time when Asia and Europe are getting hit so hard right now from the oil shock. At the same time, given the multiple prongs and the longer-term approach, that also still is in play. I mean, again, such a confusing month, especially given the fact that coming into this, people were talking about diversification outside of the world, a re-rating on tech, and then, of course, we haven't even mentioned private credit.
So, look, I've said this a few times, I know. I don't know if anyone welcomes this particular statement, but I think the stress brings out the best of Wall Street research teams. I always think that in moments like these, you see some great research. This came from Jason Thomas of Carlyle, who periodically puts out pieces that you can read at home. You can find it on the website. Just got this email from him. For the past 2 years, the Fed has been unwilling to slow demand growth to levels necessary to hit its inflation target. But now that same institution will hike rates into an exogenous supply shock, exacerbating its drag on economic activity, ? That'd mark quite an inversion of the adage that one should control the things you can and accept those you cannot. He calls it misreading the tea leaves this morning.
And a lot of people would agree. And in some ways, Fed Chair Jay Powell came out and sort of confirmed, yeah, you're misreading the tea leaves, because right now we're seeing this as a one-time price shock. We're trying to look through it. And frankly, long-term inflation expectations haven't gotten away from them. And that is what they're watching.
The 2-year back down to somewhere around 380 this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. White House Press Secretary Caroline Leavitt saying President Trump is, quote, quite interested in calling on Arab countries to step up to cover the costs of the Iran war. The costs are estimated to be in the tens of billions of dollars. The U.S. will announce key defense budget details in the coming weeks as the top line figure for national security could reach up to $1.5 trillion for fiscal 2027. That would be the largest for a year on record. The senior defense official saying more details will be released on April 21st. And Fed Chair Jerome Powell saying the central bank has little control over supply shocks like the surge in oil prices caused by the Iran conflict. The comments delivered during an address at Harvard University eased concerns that the central bank would be forced to tighten monetary policy to keep inflation from accelerating. That's Bloomberg Brief. John.
Yahara, thank you. Thank you very much. On this programme about 30 minutes ago, Michael Haigh of SocGen made the point that the UK was very close to running out of jet fuel. The president, with this statement on social media just moments ago, all of those countries that can't get jet fuel because of the Strait of Hormuz, like the United Kingdom, which refused to get involved in the decapitation of Iran. I have a suggestion for you. Number one, buy from the US, we have plenty. And number two, build up some delayed courage, go to the Strait and just take it. You'll have to start learning how to fight for yourself. The USA won't be there to help you anymore, just like you weren't there for us. Iran has been essentially decimated. The hard part is done. The president goes on to say, go get your own oil.
This has been the tenor increasingly of the conversations with European nations and the UK, given the disproportionate ramification and the unwillingness to get involved in the fight.
More on that statement in just a moment. Up next on the programme, setting the table for a deal.
It's no surprise that we are seeing the remaining elements of the regime become increasingly eager to end the destruction and come to the negotiating table while they still can. What is said publicly is, of course, much different than what's being communicated to us privately.
Up next on the programme, we'll catch up with Libby Cantrill of Pimco, live from New York City this morning. Good morning. This, of course, is a very fluid situation. There's a risk of drawing premature conclusions, but we'll start with the pieces to make the puzzle this morning. So the first piece is this report from the Wall Street Journal. Indicates the following, that the president has told allies he's willing to end the US military campaign against Iran, even if the Strait of Hormuz remains largely closed. That from the Journal contradicts some of what the president said yesterday, but let's work with that statement there. And then read this statement here from the president just moments ago. All of the countries that can't get fuel because of the Strait of Hormuz, like the UK, which refused to get involved in the decapitation of Iran, I have a suggestion for you. Number one, buy from the US, we have plenty. And number two, build up some delayed courage, go to the Strait and just take it. You'll have to start learning how to fight for yourself. The USA won't be there to help you anymore, just like you weren't there for us. Iran has been essentially decimated. The hard part is done. This is the price action. Equity futures session highs on the S&P up by a little more than 1%. The commodity market trimming gains. On Brent crude, we're now down by about 0.4%. Is the market looking at that report from the Journal, putting it together with a statement from the president, and seeing that as an endorsement of the reporting earlier on this morning?
I'm not a market whisperer. At the same time, there does seem to be a sentiment that a sort of decline in the actual hot war that's going on right now in Iran, and some sort of next phase would be positive because at least it would not destroy oil-producing facilities and would mark an end to the de-escalation at the very least. How this transpires, exactly what the European allies are going to do with this, given some of the mixed reporting on that end, remains to be seen.
I'm not suggesting that's the right conclusion, just that might be the conclusion some of you are making this morning. Equities at session highs would speak to that, up by 1% on the S&P 500. Out of surveillance this morning, setting the table for a deal.
With each passing day, the United States military is increasing its advantage over the terrorist Iranian regime. It's no surprise that we are seeing the remaining elements of the regime become increasingly eager to end the destruction and come to the negotiating table while they still can. What is said publicly is, of course, much different than what's being communicated to us privately. This remains a truly once-in-a-generation opportunity for the regime to make a good deal with the United States.
So here's the latest this morning. The White House insisting talks with Iran are progressing well following a Wall Street Journal report that President Trump is willing to end the war without reopening the Strait of Hormuz. For the latest from D.C., Annmarie has more. Hey, Annmarie.
Good morning, John. Well, that reporting from the Wall Street Journal potentially is the White House trying to undercut this message that has been really sent to the regime about how much the Strait of Hormuz is important, not just for the United States, but allies around the world. We've also seen them take a message that the Strait of Hormuz matters more for other countries. That is true in the sense that we are a net exporter, but we still have to remember we do get shipments, especially places like California. 20% of their products are coming from Asia, which is why this post on jet fuel is so interesting this morning. We've seen already the energy shock really hit these Asian countries. You have a number of countries actually saying that refined products and fuel can no longer be shipped. They want to start making sure they're hoarding. And at the same time, you mentioned this earlier, a report from Politico. The European Commission is asking member countries to consider cutting back on oil and gas use because of, quote, prolonged disruptions, potentially what's going on in the Iran war. Basically, what you're going to have is more and more countries potentially saying we can no longer export our product and we need to start conserving and we certainly need to start hoarding.
Annmarie, with the latest in Washington. Thank you. Libby, Cantrill of Pimco writing, the adage that war is easy to start but hard to finish seems to be playing out, despite President Trump wanting to bring the conflict to an end. Libby joins us now for more. Libby, good morning.
Good morning.
Apparent contradictions in some of the statements we've seen. Do you view that as strategic ambiguity or just the lack of a strategy?
Well, look, I think that the president very much wants an off-ramp. I think he realizes that politically, domestically, that this is presenting quite of a headwind to his party. I think the question is whether he can declare victory without the Strait of Hormuz opening. I think he might be trying to, but does that actually translate to market action? And then also, importantly, from a voter's perspective, does it actually translate to a decline in gas prices? Because as we know, gas and groceries, the two things that really matter to voters, particularly on the heels of the 2024 election, the bout of inflation in 2022, I mean, voters really care about affordability. And so I think this is sort of the question. I think he wants to end this, understandably, but I think really the bigger question is can he do this without ground troops? I mean, is it enough? Is it sufficient enough just to declare victory rhetorically without actually having sort of the substance behind it?
You started by saying that it's clear that the president wants an off-ramp. Is it because we're reaching up against the 4 to 6 week time frame, or is it because of the market response that we've seen and increasing pressure from the Republican Party?
I think it's all of the above, honestly. I think the president, President Trump has had a deep ideology around, lack of U.S. intervention and wanting to end these, forever wars. And I think that there may have been a miscalculation that, translating the success that he had in Venezuela was going to be transferable to Iran. And, whether that was naive or what have you, say what you will about it. But I think it was a miscalculation. And now I think that the president is likely wanting to end this. But again, I think the question is just will, again, and I said this to our traders yesterday, this is not like tariffs, right? He had unilateral control around tariffs. He could impose tariffs and then walk back from tariffs. This obviously is just much more complicated and much more complex. And so even though I think, again, the desire is to do that and is to decrease the conflict, I think it's just a question of whether he's going to be able to.
At what point is the fiscal constraint also becoming an issue, given the fact of recent reporting talking about demands on Saudi Arabia to help pay for some of the further incursion to try to solidify the Strait of Hormuz out of Iran's reach?
Hey, look, we were coming into 2026 running a deficit of around 6.3% of GDP, more or less. If you take off some of the tariff revenue, having to pay some of that back, that bumps up the deficit to sort of 6.5%, 6.7%. And then if you also overlay a $200 billion supplemental request that the Pentagon has suggested that they will be asking Congress for, then you're bumping up to 7% deficit. So I do think the fiscal here is going to be a constraint. I don't think the president will have the votes in Congress to approve that $200 billion supplemental. I think that I think Congress will likely slow walk this. So yes, I do think the fiscal is an issue. I think part of the reason why you've seen some of the yield curve do what it has is because of concerns about deficits once again.
Libby, just a final word, if you can, on this relationship with the Europeans. The president lashing out at France, calling France very unhelpful, taking a dig at the UK. Of course, the UK's really dragged their feet on showing any willingness to get involved in this war. The Italians saying just moments ago there are no tensions with the US over the military base use. Europe's very divided on this issue right now. Does Europe have one voice, and what does this relationship look like 12 months out?
I think that is obviously a very good question, an open question. If you just looked at the national security strategy, sort of the document that the administration put out at the end of last year, sort of regarding relationships around the world, they were very critical of Europe, just in terms of, from lots of different dimensions, but particularly around the security guarantee, that Europe needs to be spending more, that they need to be, focused on their own security. And so obviously this issue has just even cracked that issue even farther open. So I think it remains to be seen. Of course, this is, unconventional and somewhat unprecedented that the U.S. and Europe, our strongest ally, is having this, sort of falling out.
And the far-left Spanish government isn't exactly helping on that front either.
Well,
I left them out of it. I forgot it.
That's a whole other ball of wax that I think will be dealt with at another time.
Libby Cantrill at Pimco. Libby, thank you.
Thanks so much.
Equities near session highs. The S&P up by 1% from New York City this morning. Good morning. The longest first quarter ever coming to a close. One more session to go. Almost there. Equities bouncing back by 1% on the S&P 500 following a three-day slide on the S&P for this month, down almost 8% on the S&P 500. We are poised for one of the worst months we've seen going back to 2022. On the Nasdaq doing better, up by 0.9. On the Russell, up by 1.4. In the bond market, reversing some of the moves we've seen in fixed income. Yields lower by 3 basis points at the front end of the curve, down 4 on 10s to 4.30. The chairman of the Federal Reserve anchoring inflation expectations, and he seemed comfortable with where policy was. For those of you pricing in rate hikes on the margin. I think some of that yesterday taken back.
Aggressively waiting. We are in a good place for us to wait and see. And if that message wasn't heard loud and clear with Fed Chair Jay Powell at Harvard, then, of course, you've got New York Fed President John Williams speaking on Staten Island saying policy is well positioned. Do they talk? It seems like that. Long-term inflation expectations are consistent with the Fed's 2% goal. A screaming endorsement of doing nothing, at least for the foreseeable future.
I think they definitely talk. I think they compare notes.
I think that's pretty much a given.
Crude this morning, Brent, WTI. WTI yesterday, the first close we've seen in triple digits since this war started. WTI this morning around 104. Brent crude around 108, up by 0.2%, a 50% plus rally on the month so far. The biggest monthly rally we have ever seen. Think about how much we've seen over the last 4 decades. And this is the biggest monthly rally ever for Brent crude.
Because it's the nightmare scenario for oil markets. The Strait of Hormuz getting shut down, with now a question around whether the Red Sea can really be an off-ramp given the potential involvement of the Houthis. How long does this go on? At what point does this become a physical story? That increasingly is what everyone keeps talking about.
107.70 on Brent so far this morning. As we count you down to the opening bell, 2 hours away from the cash open with your morning movers. Danny has more. Hey, Danny.
Hey, John. A good amount of deal news this morning. Eli Lilly will be buying Contessa Pharmaceuticals for as much as $47 per share. It has a couple things that it needs in order to get there, but it's a 70% premium, values the company at $7.8 billion. It expands Eli Lilly into sleep medication treatments, so shares up 48%, 1% for Eli Lilly. Elsewhere, it's a deal we've been monitoring for at least a week now, and it is McCormick. Unilever in talks to create a food giant with McCormick. Selling them, it would create about a $60 billion food giant. McCormick also reported earnings better than expected as well for this spice company, so shares up 3.6%. By the way, we might expect that announcement as soon as today. Finally, wrapping things up with Morgan Stanley. Reuters reporting this morning that SpaceX planning to work with E-Trade, which Morgan Stanley owns, in order to sell placement for its IPO to retail and smaller individual investors. It's a big win for E-Trade, and it also might include icing out some of the other retail brokerage platforms like Robinhood and SoFi. Shares up 1.5% in the pre-market for Morgan Stanley. John?
Danny, thank you. Thanks for the update. Checking out the banks. The banks down on the month so far by around 5% on the S&P 500. On our radar this morning, President Donald Trump signaling a potential off-ramp for the war with Iran. The Wall Street Journal reporting the president is willing to end the military campaign without reopening the Strait of Hormuz. Elsewhere, European officials warning that Tehran is pushing Houthi rebels to ramp up attacks on the Red Sea. Leaders of the militant group are weighing more aggressive action in response to further U.S. escalation of the war. And finally, the Secretary of State Marco Rubio saying the U.S. may need to re-examine its relationship with NATO following its lack of support in the war with Iran.
I think it was very disappointing. One of the reasons why NATO is beneficial to the United States is it gives us basing rights. But if NATO is just about us defending Europe if they're attacked, but them denying us basing rights when we need them, that's not a very good arrangement. That's a hard one to stay engaged in and say this is good for the United States. So all of them's going to have to be re-examined.
Italian media reporting Italy denied U.S. aircraft bound for the Middle East permission to land in Sicily. Spain closing airspace to American flights involved in the operation in Iran. The president this morning making comments about France, about the UK. There's a clear divide right now for European nations.
And that's one thing that makes it difficult for the United States to deal with Europe as a whole and with NATO nations as a whole. You can sense a palpable frustration in the administration that the United States is spending a lot of money and is trying to secure the Strait of Hormuz for the passage of oil and natural gas that goes primarily to places that do not want to get involved and don't even necessarily want to help. There is a sense of deep dismay that this is going to happen. At the same time, on the flip side, the European Union is beset by the fact that it's conflicting nations that don't have any kind of consensus on what they want to do, and they tend to be slow moving. So this is a tough situation. How much more willing will some of these nations be when there's a fiscal shortage that prevents people from going on vacation and heating their homes?
Yeah, then things change very quickly. There is a sense of real concern in the commodity market. Iran holding its grip over the Strait of Hormuz. Michael Haigh of SocGen warning supplies of jet fuel in the UK are running out.
The final vessel carrying jet fuel into the United Kingdom is going to get here in 48 hours, and there's no more after that. So Asia's already feeling the crunch. You've heard Spain and other countries lifting excise duties on gasoline and diesel. So it's starting to come here now.
That was Michael Haigh of SocGen. 30 minutes later, About 30 minutes later, the president saying this: all of those countries that can't get jet fuel because of the Strait of Hormuz, like the United Kingdom, which refused to get involved in the decapitation of Iran, I have a suggestion for you. Number one, buy from the US, we have plenty. And number two, build up some delayed courage, go to the Strait and just take it. You'll have to start learning how to fight for yourself. The USA won't be there to help you anymore, just like you weren't there for us. Iran has been essentially decimated. The hard part is done. Go get your own oil.
There are two sides to this. On one hand, frustration in the administration that the nations that are affected most significantly are not necessarily coming to the aid or doing much to do anything with that. On the flip side, the Europeans are still saying, well, we didn't start this war. And that's what you're hearing from Saudi Arabia as well. And the U.S. says, well, if you want us to keep going with it, you got to help. You got to step in. And that clearly is not a conflict to be resolved in the very near future, but it needs to be as this continues.
Let's get you a view down in Washington, D.C. with a special guest. Annmarie stands by for more. Hey, Annmarie.
Hey, Jonathan. Good morning. That's right. I'm joined by Amos Hochstein. Of course, we all know him as a former senior advisor to President Biden, an individual who was counting the barrels when they were also dealing with an energy crisis. He's now at TWG as a global managing partner. Amos, thank you so much for joining us. So the president has this Truth Social post. And I remember when you were also tracking every single barrel that was on the market. You were also tracking every single product that the United States was exporting or importing to try to help European allies. Is he correct here? Is Europe now, one, going to feel this shock? And can the United States maybe even come to the rescue?
Well, Annmarie, the shock started in Asia, right? So energy shocks take time to materialize because when Iran closed the straits by threatening to and demonstrating their willingness to shoot at tankers, the shock starts then. But the feeling of the shock only starts several days, if not weeks later, because there are ships on the water that are on the way. Countries have storage. The unsanctioned Russian on the water barrels. So there's some product and oil that's coming through for several days. And then the crunch starts. We've seen that in Asia, where they're stopping flights, they're stopping domestic flights, they are conserving energy. Some countries have moved to a 4-day work week, like Sri Lanka. There are countries that have, like Thailand, that have told people to stay home and work from home back to COVID days. There are countries that have already said that the business side should stay home. So then it moves to Europe, right? Because it's moving around the world. And then after Europe, it comes to the United States. We are more self-reliant, but we're not entirely self-reliant. We import a lot into California during the year. We import in the summer into the East Coast. And we don't always have the ability to move product around the United States. We don't have enough infrastructure, pipelines to move things around. So this crunch eventually comes to us. And by the way, one accident in the United States, and we have a problem. Valero just had an accident at their refinery in Texas last week. It's still not fully back up to operation. They make jet fuel.
Well, let's hope we don't get there. Let's stick on Europe for a minute. Politico has a story about the European Commission asking member countries to consider cutting back on oil and gas. Are they going to have to do that? What sort of policies do you think the European Union could put in place?
You know, when I was at the White House, one of the things that I worried most about was not sounding like Jimmy Carter telling Americans to wear a sweater in the last time that we had an energy crisis in the United States. The Europeans are coming very close to that. I hope they learn the lesson, the political lesson. Don't tell people to, to travel or bike to work. But look, for Americans, there is no doubt that this spring is going to be a very different expectation than what they had before, as far as gasoline and diesel for their cars and trucks, and for their travel by air. Jet fuel surcharges are coming to the airlines, and they're already here, and they will surge going forward, because airlines have to fly to other countries where they have to fill up. And if there's no jet fuel there, then they won't fly there.
You've dealt with the Europeans a lot, though. Just taking a step back, what do you make of their messaging and how they're dealing with this White House? The United Kingdom said that maybe they would send the Navy after the conflict was over. Spain is closing its airspace. Italy, apparently, according to one report, wasn't letting a U.S. aircraft land at its base. Who is the United States dealing with right now when it comes to leadership in Europe, which feels very fragmented?
Well, Europe definitely is fragmented. There's no unified position in the EU. And there are outliers. Spain is an outlier, and I will say Spain was an outlier during the Biden administration. it has taken this leadership, plagued with its own scandals, has been taking a very hardline, anti-American, generally.
And almost pro-China.
Look, this is a country that I don't believe we should be doing business with when it comes to sensitive technology, because they've allowed Huawei into their intelligence systems, right? This past summer, they granted them a contract for their wiretapping for their intelligence community. So I put Spain aside. I think the Europeans, though, fundamentally say, look, NATO and our alliance is when one is attacked, the other is attacked. You know, one for all and all for one. Their view is the United States wasn't attacked. This was a decision to go into preemptive war that no one really understood, wasn't lobbied for. We didn't have months of explanation of why we were going to war. It was a decision and then an expectation that they join. And I think that's where the resentment is. You took us for granted. You didn't even come and tell us why you were going to war and then told us we had to go.
The heads up was the issue for the Europeans. They wanted to be on the same page. Is that what
and
you're
the
saying?
deliberation, understanding what's the goal, what's the cause of the war.
Well, I think this administration was consistent on the three things. They don't want Iran to have a nuclear weapon. They want to get rid of their ambitions when it comes to long-range ballistic missiles, and they want them to stop funding proxies around the region, which are terrorism.
Well, number one, nuclear was obliterated in the summer, and there's no evidence that there's been almost any attacks in this war on the nuclear facilities, because they've largely been damaged, and there was no restart of any nuclear activity. On the missiles, yes, but there was plenty of time for that. There was no time crunch to go after nothing. There was no precipitating event on Iranian missiles. It is important to take out those missiles, without a doubt. There was no negotiation attempted. There was no urgency on the missiles. And support for the proxies, no doubt. But Annmarie, the support for the proxies is largely financial. Iran was making more money we could have shut down their oil trade in 2025. We didn't. They grew to 2 million barrels a day. They were making more money. In fact, they're making more money since the war started. They're selling more oil at a significantly higher price without sanctions.
With the unsanctioned Iran oil at sea. I just want to end on the United States. $4 a gallon. Psychologically, what does that do to a White House, or does we need to wait for it to get to $5?
$4 is already a psychological barrier, not for the White House, but for the American people. Seeing those prices, those stickers as they drive by and walk by gas stations, and the toll being taken, that is already taking the toll. I think the bigger issue, and when I was at the White House, we talked a lot about gasoline, but privately, I told everybody from the president on down that we should worry much more about diesel. And the diesel prices have risen more than the gasoline. We're having a hard time making enough diesel in the United States. And diesel is what will determine ultimately the increase in prices on food and on everything we buy on Amazon or any other retailer. It comes to us on a truck. And the trucks are having to pay that price. And remember, a lot of trucks with our products and farm products come from California, where the prices are over $6, are at $6 a gallon. That is, and diesel prices going over $7 and $8. So those are going to affect American consumers in the coming days and weeks. And I think next week is going to be that week where the shock in Asia to Europe starts playing out in the United States. And you know, on a Monday and Tuesday, the president talks about negotiations. We've had that now for 2 weeks in a row. Monday, Tuesday is about negotiations. By Thursday, the market realizes there's no real negotiation. The idea of ending the war with the straits closed is not really ending the war. So we haven't been presented with anything except for vague talk about an end of war. We don't know how this war ends yet. And as we sit here Tuesday, we're no different than we were last Tuesday. And it's just discussion of it. It's managing the markets. So I think from the market perspective, we're still underpricing oil. We are underpricing economic impacts of this energy shock.
Amos, thank you so much for your time this morning. Of course, that was Amos Hochstein, former senior advisor to President Biden, basically saying financial markets, global energy markets are complacent in terms of what is going on in the Middle East. And I just checked diesel prices, $5.45 a gallon for diesel. And to Amos's point, that's critical for the United States as we are a farm-to-table economy. And this is potentially going to creep into things like grocery bills.
Annmarie. Thank you. Annmarie down in Washington, D.C. When we talk about $4 a gallon gasoline, we're talking about the average. Different states have very different experiences. California, something closer to $6. Diesel, the price of diesel flying as well.
Yeah, the idea that, as Annmarie was just saying, $5.45 for diesel, it brings us almost at the peak of where we were in 2022. I think just it's a good reference point. There it was $5.81 at its peak. We are far from the peak when it comes to average gasoline prices. Think about the pass-through for a lot of goods and services. That's the reason why the economic ramifications, Amos was saying, maybe have not been fully realized.
I wish we were a little bit more farm to table. I know you were thinking the same thing as Annmarie was saying.
I was thinking, is it farm to table with the Tic Tac, the different candy that gets shipped across the country? You know, I don't know.
I know she didn't mean it literally, but you know.
Yeah, I mean,
I was right there with you.
I mean, I was laughing because I was like, yeah, you know, those trucks are coming from Vermont.
RFK agrees.
I know. Well, you know, I'm
course.
just going to drink whole milk.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump calling on countries that can't access jet fuel due to the Strait of Hormuz closure to either buy fuel from the U.S. or go to the Strait and, quote, just take it. The president adding countries need to fight for themselves, saying the U.S. won't be there to help any longer. An Iranian drone struck a fully loaded Kuwaiti oil tanker docked in Dubai early this morning. The vessel was in an area packed with ships waiting to leave the Persian Gulf. The strike damaged the hull and started a fire, but no oil was lost, and all 24 crew members are safe. And as Annmarie was discussing with Amos, U.S. gas prices have officially topped $4 a gallon for the first time since 2022. The nationwide average retail price for regular unleaded gas rose to almost $4.02 a gallon. That's more than $1 since the start of the Iran war. That's your Bloomberg brief, John.
It's a big change in just a month. Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, facing inflation spillover.
A lot of economists talk about this being an oil shock. This will feed through to many different parts. Never underestimate the potential for the US to bounce back as well. It's a very resilient economy.
Up next, we'll catch up with Christina Campmany of Invesco from New York City. This is Bloomberg Surveillance. Live from New York City this morning. Good morning. Here's the price action. Equities near session highs on the S&P 500, higher by 1%. Under surveillance this morning, facing inflation spillover.
You will see second-round effects of inflation. A lot of economists talk about this being an oil shock, and they kind of forget that it's also about polyester, it's also about fertilizers, it's also about everything to do with helium, and this will feed through to many different parts. Never underestimate the potential for the US to bounce back as well. It's a very resilient economy. This is a very, very precarious time for central banks to lean on the idea of this being transitory.
So here's the latest this morning. Investors bracing for an economic slowdown, market shifting focus from war-driven inflation threats to a potential growth shock. Christina Campmany of Invesco writing, while aware of the change to the inflation picture and risk of even higher energy prices, we have been focused on the hits to growth. Christina joins us now for more. Christina, good morning.
Good morning.
Is Chairman Powell on the same side with you?
I think so. Yesterday felt like a bit of a breath of fresh air of like, we're actually playing by the rule book of you're supposed to look through the one-time energy shock and like what are the follow-on effects here? And I think growth is something that we've been focused on from the beginning of where we go from here.
Is that enough to sort of give you confidence to go back into debt? And I'm not just talking about government debt, but also credit?
I think we haven't seen, there's no policy bazooka on the table that feels like, okay, we have a rescue, like what we were talking about before of, it's different from COVID that doesn't seem the impetus on the table. And I think if anything, right now you're talking about markets have shifted this focus to central banks. Are we hiking in the face of inflation rather than this? Does it give us, is there opportunity in the market? I think absolutely a lot of value has been created. Credit, I think we're still a little more cautious about because I think valuations are tight. But front end of development rate government bonds, I think there's a lot of value because I think that there are places like, I don't think that the Fed is hiking. I'm not sure that the BOE is hiking. I don't think that that's the kind of crossroads where we're at.
What does that say about your expectation for growth down the line if the place where you see opportunity isn't credit spreads at the widest going back to late last year, but at the front end of yield curves around developed markets?
Okay, so credit at the widest in the last year, but how tight has credit been for the last 5 years. I mean, credit has performed exceptionally well, has been very tight, and is a jump risk asset. So I think you have to be cognizant. We already had growth in the labor markets in a very tight place that were susceptible to shocks, and this is clearly a shock. And I think labor markets have been noisy, but we have an employment report this week that the market is clearly not focused on because there's so many other things going on. But I think a series of weakness in the labor market, that is something that the Fed is going to be concerned about, and we should all be concerned about are there cracks in growth that need to be responded to.
How instructive do you think that jobs data will be?
I mean, I think like all of these labor market numbers and data prints that we have government shutdowns. We have a lot of noisy factors that are going on. So I think you do have to look at kind of the trend in 3-month averages. But I think the market will react, even if break-even payrolls is 0 or plus 50.
So it's a bad report. Is this a market that would price in rate cuts again?
I think it's hard to flip back very quickly to flipping in easing from, right? Like we shifted from this easing bias to hiking bias. I think it's harder to switch back. But I do think by year end, we will be talking about a Fed that is easing for sure. And
1 or 2 cuts by the year end still the base case?
For us, I think so.
OK. Christina, good to see you.
You too.
Thanks for being here. Christina Campmany there of Invesco on fixed income. Some of the spread widening we've seen and the value created. I love this slide because I've heard it so many times from people in fixed income. The value created in fixed income, not just in the US, but worldwide, the massive backup we've had in yields.
Yeah, and value created, not at the long end, because that's too much conviction, at the front end, which is essentially going into cash, the belief that the central banks are not going to necessarily hike rates to the degree that people previously expected. It's sort of misreading the tea leaves, as you were talking about from Jason Thomas at Carlisle. Can I just say that after these 3 months, the amount of sighing that we're hearing from different guests that are trying to parse through this and come out with something gives you a sense of the mood right now on Wall Street. It's just this collective, what do I do with this? I don't know.
We've had some massive moves. Check out the US, Germany, UK and Japan again. Check out that board. And if we can, put it over 1 month and just look at the moves we've had over the last month, the month of March for those markets. The US, we've had the highest yields since last summer. Germany, the highest yield since 2011. The UK, the highest 10-year yield since 2008. Japan, the highest yield since the 1990s. We've had some big moves this month.
And those are in the 10-year yield. In the front end of the yield curve, the ECB are now pricing in 3 rate hikes by the end of this year, even as you have really neutral messaging coming from ECB officials. You wonder why people aren't saying necessarily it's a screaming buy on the long end. And I keep going back to the fiscal constraint. If there is a downturn, what kind of firepower do different governments have to really spend a lot to save it, considering the pushback, the bond vigilantes, as Ed Yardeni calls them?
Coming up on the programme, the conversation continues. Nadia Lovell of UBS, Vikas Dwivedi of Macquarie, the US Trade Representative Jameson Greer and Drew Pettit of Citi. The third hour of Bloomberg Surveillance. Up next.
It all boils down to how bad the situation gets, how long it persists, and that'll tell you what the implication on inflation is.
It does take time for changes in oil prices to work their way into the economy.
You will see second-round effects of inflation.
I do think financial conditions have tightened.
I am concerned about the fiscal outlook.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
And breathe. Take a deep breath. What a month it's been. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now on the very edge of the longest first quarter ever, and what a month to round out Q1. Check it out. On the equity market for the month, on the S&P 500 down by 8%, the worst month since 22. Over in Europe, the worst month since 2020. On the Nikkei, the worst month since 2008. An ugly month for stocks and for bonds as well. Look at fixed income. Over in the UK, the highest yields we've seen since 2008. In Japan, the highest bond yields we've seen since the 1990s. And at the heart of it all, this move here in the commodity market, Brent crude on the month higher by more than 50%, around 50% higher. The biggest moves we've seen on record in the commodity market.
And this upset the apple cart and the narrative and a lot of the momentum trades heading into the month of March. Just think about what the narrative was heading into this month. It was a soft landing, the rest of the world outperforming the United States, this growth expansion of the world, and bam, that oil price rise just really torpedoed a lot of those hopes and dreams, particularly in countries that are most affected by it. It raises this ultimate question of heading into April. Can it be stopped? Do we get sort of a retracement of some of these levels? And exactly what can work if it's an inflationary shock with no real clear policy levers to respond?
Is there an off-ramp? Stocks are doing better this morning. The S&P 500 up around 1%. Crude trimming that gain. We're down by a few tenths of 1%. This from the Journal. The president telling aides he's willing to end the U.S. military campaign against Iran, even if the Strait of Hormuz remains largely closed. The complete opposite of what we heard from the president directly on social media just yesterday.
And people are viewing this potentially as not necessarily creating the escalation that they were concerned about yesterday. There's a larger signal, though, coming over the past couple of days. There's been a lot of discussion around what the response and involvement will be from Saudi Arabia, from the UAE, from European nations, especially as we get some pushback from a number of different countries about how much they want to be involved, even in letting U.S. planes land. How much is there a need for some of these nations to join the effort, particularly because of their exposure to the commodities that are transported?
The shortages will ripple through Asia. They'll arrive in Europe pretty soon. We've seen the pushback from European officials, the worry about shortages. Here in America, $4 gasoline on average. In California, $6. If you're getting closer and closer to the midterms, you're in a tight race, and you've got an allegiance and alliance with the president right now in the Republican Party, you're in a tough spot if this continues.
Which is why when we were talking with Libby Cantrill of Pimco, she said there's no appetite in Congress to pass a $200 billion supplemental bill to finance any further ground troops or anything of that nature. There's also pushback in end this soon because we've got to get back on track. Key question, if the U.S. pulls out without solidifying the Strait of Hormuz outside of Iran's control, do oil prices really retrace that much? And I don't know that I have a clear answer on that.
Let's get into it. Coming up this hour, Nadia Lovell of UBS with stocks looking to end a rough quarter on a high note. Vikas Dwivedi of Macquarie warning crude could reach $200 a barrel if the war continues through June. And the US Trade Representative Jameson Greer on the status of global negotiations. We begin this hour with stocks rising following reports that President Donald Trump is willing to end the conflict in the Middle East without reopening the Strait of Hormuz. Nadia Lovell of UBS Global Wealth Management writing markets are responding more to shifts in the news flow than to fundamentals. Our view is not to trade geopolitics, but to remain invested while gradually reducing risk if elevated oil prices persist. Nadia joins us now for more. Nadia, good morning.
Good morning.
It's good to see you. So things have changed. The fundamentals have shifted. The outlook for crude is about $20 higher than it otherwise was. You've got UBS 86 now for the year, Goldman 85, SocGen around 80. What do those higher energy prices mean for your outlook for growth?
Look, we do think that it does shape a bit off of growth. Our initial expectations was that this to be wrapped up by the end of this month, early in April, and we had expected oil prices, Brent, to hover around $90 into the early summer. Now, the longer this goes on, obviously, it puts upward pressure on oil prices, and you could see oil prices overshoot to the upside to $150. That would lead to demand destruction and potential some hoarding of oil. And so that could mean that we see in the U.S., instead of the above trend growth that we were looking for in the U.S., we could see slightly below trend growth, something under 2% instead of 2.5% that we're looking for. Ex-U.S. in Europe, we're looking for 1% GDP growth. That likely means that comes down closer to sort of a flat, and we could end up in a stagnant inflationary environment in Europe. This is why we have been taking down risk, not doing a wholesale, sort of exit of equity markets. We still remain strategic positions in equity markets, but we have been slowly de-risking because of the potential for high oil prices.
Let's sit on the US equity market and talk about sector preferences. So the inevitables happened. The likes of Oxy up by 25%. The energy-facing names, refiners doing really well on the month on the S&P. Consumer-facing names, travel, Norwegian. Anyone who's doing a cruise right now, good luck to you. Southwest down to like 25%, something like that for the month so far. Did you like that other dig at? Yeah, okay.
Couldn't have happened to better people. I mean, come on.
Love the cruise.
You just
Love the
keep
cruise.
coming back to it.
Rambo,
Carry on.
I went for the individual performance.
I know, of course. And that's the one that you pick out, cruise lighters.
That's the one that jumped off the page.
What a shocker.
That's the one that spoke to me.
I think you secretly want to take a cruise.
On a cruise.
Exactly, I think so.
That's the one that spoke to me.
It speaks to you, John.
Get to my single.
Don't resist.
I have no I have no interest whatsoever.
You can see me laughing over here.
Going on a cruise. You could offer me the cruise cruise for free with $10,000 spending money on the ship, I wouldn't go on that cruise.
Thou who protesteth too much.
OK, all right. Nadia, let me continue. The names that have underperformed and outperformed on the month so far, is that a story you expect to persist?
Don't expect that to persist. You know, obviously the energy complex, energy sector is pricing in a more sustainable higher oil prices. We don't expect that to happen. When the Strait reopens, which we do think that that will happen, it's a matter of time. Maybe it happens in the next few days, maybe it happens in the next few weeks or the next few months. It will take some time for oil to fully ramp up, probably a month to 3 months for it to reach around the globe. But, you know, the fact is we do think that the energy sector probably will see some retracement. Does this mean that oil prices is probably higher in the longer term? Yes. And so some exposure to sort of the oil services companies, maintaining that exposure makes sense. But at the same time, we also use this opportunity to start to look to some of those areas that have underperformed, because we know the market will not wait for clarity. The market is just looking for, are things getting less bad? And that's why you see on days where, you know, these True Social posts suggest that there's a de-escalation, you could see a rally in the consumer discretionary parts of the market and some other the more cyclical exposed part of the market. Now, if gasoline prices, and we've heard this from Walmart, move above $5, that could be a potential headwind near term for the consumer. That's something that's a risk.
Is big tech defensive right now?
You know, it's a mix, right? Historically, one would have said yes. But remember, even before coming into this wasn't an energy issue for big tech. It was concern around AI disruption. We've seen some, you know, sell-off more recently in the more parts that had held up better, like the memory stock after TurboQuant formed the new compression method that could potentially decrease the need for memory. We think that that's oversold. So we would actually take the opportunity to leg into those memory stocks that have pulled back, also the cybersecurity stocks that have pulled back in recently. I mean, the reality is, as AI adoption increases, that increases the chances of cyber threat. And so we think over the longer term, there are opportunities within tech. But right now, tech will not operate, you know, in a defensive manner as it has historically, because people continue to question the longer term value of these stocks. But we think that there are select opportunities within tech.
We've seen a bigger underperformance coming from Asia and coming from Europe. Before this conflict, people were talking about the broadening out trade. Go outside of the United States, you're going to see better results from that. Does that hold true even more so today, given that you've seen an even bigger drawdown in places like South Korea, Japan, in places like Europe?
You know, obviously that broadening out trade is taking a pause. But again, like near term, we do think that there's some headwinds to that broadening out trade. This is why we've taken down some exposure in terms of the more cyclically exposed market, as well as those markets that are highly sensitive to higher oil prices. We've taken down, neutralized Europe and the Eurozone, as well as India. Now, we've kept our preferences and attractions on areas like Japan and Asia X, because we do think we want to be positioned for a rebound. Should there be a de-escalation in this conflict, those markets are probably positioned to see that that rebound in the market. And remember, areas like Japan still have that fiscal support from the Takaishi trade. Also, the fact that they do have exposure to the AI capex supply chain as well. And so we want to maintain some exposure there. But again, this is about risk management, right? Again, this isn't about being overly bearish or overly bullish in this market. It's about managing those risks in a volatile environment.
When more of that fiscal space starts to go towards things like defence spending, to supporting consumers to pay energy bills, how does that change how you see what it means for the equity market?
So in Japan or in the U.S.?
In Japan specifically.
Yeah. So and it's sort of like our sort of thinking around that is that, yes, maybe near term you could see some potential for the government need to support the consumer on that side. But longer term, I do think that we can probably all agree we live in a more hostile environment. And there is going to be a longer term need strategically to increase defense spending, to increase energy security. And so we would continue to look to have exposure to those areas of the market in Japan. Near term, there could be, potential headwind to that. But we do think that when you think about a year or two out from now, those stocks are probably higher.
Nadia, it's good to see you. Thanks for dropping by. Appreciate the update. Thank you. Nadia Lovell there of UBS Global Wealth Management on equity markets and on cruise stocks.
I honestly, your obsession with them makes me think that you're just really curious, and that secretly this has always been the desire of Jonathan Ferro. So that's what I have been left with from this conversation.
Not just cruises, but Southwest as well. Southwest down by 25%. What was odd about this month, of course, is that we got an update from the airlines, and they were seeing some of the hottest demand they've ever seen coming into this war. And then you've had this shock. Two shocks, really. The lines you've seen at the airports and the shock to fuel prices, too.
And you've had two different responses. On one hand, you've got the Delta and the American CEOs saying that they've actually upgraded their expectations for the year because consumer demand is going to remain robust. And then you have United saying, ultimately, this is going to come in the form of higher prices and demand destruction down the line, and they're preparing for that. Either way, the interesting thing to me, and you asked a really great question that I think we have to think more about, which is fiscal spending different when it comes to growth, when it's to plug the gap in holes that are created by a crisis? And that ultimately might be some of the response that you're seeing at the long end of the yield curve. And that increasingly is going to become a discussion.
Let's give you an update on what's happening down in Washington, D.C. There's a briefing taking place at the Pentagon right now, carried out by Defense Secretary Pete Hegseth. Annmarie's been tracking that story for us. Annmarie, what's the latest?
Yeah, the Secretary of Defense, Pete Hegseth, is saying that the upcoming days are going to be decisive when it comes to the war in Iran. He's briefing the press this morning. He says Iran will still be able to shoot down some missiles, but the United States will counter that and, of course, continue to shoot it down as well. Also coming through, Jonathan, is CBS is reporting they had an interview with the President of the United States, allegedly, according to their social media. And Trump says he's not pulling assets in the Strait of Hormuz just yet. So this is interesting because it comes, of course, on the heels of the Wall Street Journal reporting last night that the president was telling allies that he was waiting, allies within the White House, that he was in his aides, that he was potentially weighing ending the military conflict without making sure that the Strait was operating as business as usual. And at the moment, he doesn't seem to be moving any sort of American hardware or material facilities that are on the ground there. So an interesting update. At the same time, the Treasury, the Defense Secretary is saying that the strikes are damaging Iran military morale. And I think most importantly, that the upcoming days are going to be decisive.
Annmarie, appreciate the update. More from Annmarie in about 20 minutes' time. She'll be catching up with Jameson Greer, the US trade representative. So look out for that conversation around 8:30 Eastern time. Equities just off session highs. We're still positive by 0.9% on the S&P. With an update on news worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. President Trump is ramping up threats on Iran even as he considers his options. The Wall Street Journal reporting the president told aides he's willing to end the U.S. campaign even if the Strait of Hormuz remains largely closed. The report says the concern is that a mission to open the choke point could extend the conflict beyond the timeline. Meanwhile, the president this morning calling on countries that can't access jet fuel due to the closure of the Strait of Hormuz to either buy fuel from the U.S. or go to the Strait and, quote, just take it. Trump adding countries need to fight for themselves, saying the U.S. won't be there to help anymore. And Secretary of State Marco Rubio saying the U.S. may need to reassess its relationship with NATO after the Iran war is finished. Speaking to Al Jazeera, Rubio criticized what he sees as a lack of support for U.S. operations in the Middle East from those member countries. That's Bloomberg Brief. John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, the morning calls. Plus, we'll catch up with Vikas Dwivedi of Macquarie, warning that crude could reach 200 if the war continues through June. That conversation up next. Live from New York City this morning. Good morning.
There is no doubt that this spring is going to be a very different expectation than what they had before. As far as gasoline and diesel, jet fuel surcharges are coming to the airlines, and they're already here, and they will surge going forward because airlines have to fly to other countries where they have to fill up. And if there's no jet fuel there, then they won't fly there.
That was Amos Hochstein, the former White House senior advisor under President Biden this morning. Equities doing OK, up by 0.8% on the S&P 500. The stress of this war, though, the scars linger on this market. The S&P 500 down by 8% so far this month, going into the final day of trading of March and of Q1. On the Nasdaq right now, higher by 0.8. In the bond market, shaping up as follows. Yields lower by 4 basis points on 10s, 4.31. Even as these moves persist, which is curious, and we'll see which one sticks. Brent crude, 108 this morning, higher by 0.7%. The report from the Wall Street Journal setting the tone for this market. Reading as follows. The president told allies he's willing to end the U.S. military campaign against Iran, even if the Strait of Hormuz remains largely closed. Now, the former might be bullish for stocks. The latter, I'm not sure it's bearish for crude.
Well, it's really the key question, I think. How much would crude prices go down if the U.S. ends its military actions in the region, but the Strait of Hormuz remains squarely under Iran's control?
It's the price action. Let's get you some morning calls. First up, Citi cutting its price target on Micron to 425, citing the recent pullback in memory prices. Your second call from Piper Sandler, raising its price target on Tamboran Resources, expecting the Iran war to place a premium on long-term gas resources outside of the Middle East. And finally, TD Cowen cutting its price target on Kimberly-Clark to 96, saying companies will be unable to fully mitigate higher oil-related costs due to the war with Iran. The corporate guidance over the next month, Bramo, we're a few weeks away now. 2 weeks or so away from hearing from the banks. The corporate guidance is going to be absolutely critical. How do they anchor expectations with this much uncertainty?
And you might get a forward read on that tomorrow when we get ISM manufacturing data coming out. If you see prices paid really surge, you might get a sense of how much they're going to have to signal, either whether they're going to accept the hit to their margins or whether they're going to pass on the price increases.
Crude this morning holding on to triple digits following reports the US could look to wind down hostilities in the Middle East. Vikas Dwivedi of Macquarie writing the market is still expecting President Trump to soon declare victory, but noting should the war continue until the end of June, crude could reach $200 a barrel. Vikas, we've got a lot to talk about, buddy, so let's take it from the top. I imagine you've been asked this question already this morning. The story on the Wall Street Journal. When I ask you what would happen, let's say this is right, the president pulls back, ends the campaign, calls it successful, mission complete, but then leaves the Strait of Hormuz largely closed for everyone else to figure out. What would it mean for this market?
That situation had, obviously, we're asking about it. We're talking about it this morning. The odds of that are rising. That situation would take some of the risk premium out of the market, but it wouldn't fix the physical challenge, right? The physical market is already too tight, and we think it'll just keep getting tighter unless the Strait reopens with a U.S. declaration that, the war is over. Without those two going together, you will start running through SPRs and other mitigation, right? So that will, we think, just continue to put upward pressure. But it may not be exactly what it, initially looks like. The real challenge may be on refining margins. And, we've already had record refining margins, but it may still be cheap right now.
Can I ask you about how big the cushion is at the moment? We spoke to SocGen and Michael Haigh in the previous hour, and he said the final vessel carrying jet fuel into the UK is going to get there in 48 hours. He was in the UK, he was talking about that market specifically, but we're seeing other problems elsewhere. Given that you've got visibility on this, you can see the tankers literally moving, you can see what's going to arrive and what's not going to arrive over the next several weeks. How big is the cushion right now? When do the shortages start to turn up in some of these bigger markets?
He's correct. A lot of the refined products going into Europe, the last cargoes will be arriving in the next couple of days. Globally for crude oil, a lot of the last cargoes that left before the conflict going to Asia will be arriving in the next really 7 to 10 days. So after that, you will have to start drawing down on stocks that are both onshore and offshore. That is a decent cushion, though. I think you can handle that for another month. OPEC does have a couple 100 million barrels that were outside of the Middle East available for this kind of situation. They're using that already, and that's going to help as well. And then the SPRs around the world will start to be available. So all of these mitigation items will be helpful, but they're not enough. By our balances, you still need something on the order of 4 to 5 million a day of run cuts in the refining sector to rebalance the oil market. But if you do that, you're going to end up even shorter and shorter on those very fuels, like you mentioned, jet fuel being one of the big ones.
How quickly could some of that get restocked, right? You said that if we wait for a month, we might work through the ongoing stores that are available in some of these regions. What about, 3 weeks if, let's say, the conflict ends and the Strait of Hormuz opens up? How fast could production get back into tankers, get back over to these places?
The production that's shut in right now, which we think is around 12 million barrels a day, will be able to come back quickly. The geology and the logistics in the Middle East, anything that's not damaged, and mostly it's not, on the production side will be able to come back. And really within a couple of weeks, things should start to normalize. There is a lot of oil on tankers right now that could be made available. The minute they can transit Hormuz, they'll do that. So you'll get a nice surge of resupply. But you still have to cover the transit time, right? That's still 4 to 6 weeks, depending on where. So the availability of those cargoes for refiners may be, you could think about it as from the time transit is okay, it could take 4 to 6 more weeks for those barrels to actually start showing. On the refining side, however, we think it could be tougher because we don't know the damage right now. We don't even know how many barrels a day are out. We know it's a lot. We think it's the run cuts from managing storage is probably about 3 million a day globally, mostly in Asia. And then the damages are probably another 3 to 4 million that's out, largely in the Middle East. Those could take quite a bit more time to get back up and running and then deliver those finished fuels versus crude.
Vikas, it's good to see you, and I can just say thank you on behalf of the team for keep appearing on the programme every week to give us an update on what you're seeing. Vikas Dwivedi there of Macquarie. I've said this a few times. In moments of stress, pain, Wall Street research teams come up with some great work, and the guys in the commodity market right now doing some brilliant research about the visibility they've got on where there might be shortages, where you'll see shortages next around the world.
You see these pictures that they're tracking of the tankers as little dots and where they're sort of sitting, and then trying to game out the amount of time that it's going to take to actually get those barrels onto the ground. The physical shortage is what they keep focusing on. I'm looking at his $200 price theory if this conflict goes to June, and I'm just wondering what that would do to the forward curve. Would that bring it up or would that bring it way down? I mean, we don't even have an understanding of exactly what the reaction function is over the next 6 to 12 months. Should there be an even bigger spike in oil prices?
These guys are deeply concerned about what they're seeing in physical markets for crude and crude product, and we understand why. I also understand why there is a degree of comfort in the equity market because they're still looking at this extremely backwardated curve, and the idea being that this will get resolved in the future and then prices start to come down. I've got all of that, but at some point you start to become more concerned elsewhere, don't you? You start to see the shortages spill out from Asia into Europe, and you start to ask the question about what that means for growth in a much more material way.
Should anyone say wear a sweater? Everyone's going to hide.
You've seen a real turnaround in the bond market that maybe speaks to that too. Up next, important conversation on trade. Annmarie down in Washington, D.C. with Jameson Greer. Another statement from the President of the United States, some comments speaking directly to CBS, we understand. I'll share those headlines with you right now. Not much more has to happen to declare victory. This, the President, according to CBS, saying the war is 2 weeks ahead of schedule. Will be hard for anybody to remove Iran's uranium. Those headlines crossed in just moments ago, and this equity market pulling out to new session highs. On the S&P up by 1%, on the Nasdaq up by 1.1, on the Russell up by 1.5. Some encouragement, and we've said this a few times. I'll say this up front. You have to be careful about drawing premature conclusions, but those comments speak to the reporting that came from the Wall Street Journal earlier on this morning, which set the tone for this market rally, which, as the President's told aides, is willing to end the military campaign against Iran, even if the Strait of Hormuz remains largely closed. Now, you've got no idea what's going to happen day to day because this completely contradicts everything we heard yesterday morning directly from the President. But that's the story so far this morning.
This leans on the first part of the Truth Social post that President Trump put out yesterday, which is that talks are going well and that essentially it could end soon. It doesn't reiterate the potential for some sort of escalation. It doesn't reiterate any potential attacks on civilian infrastructure or anything of that nature, which might be the sort of stick that had been holding equities lower.
The problem the market's got is which version of the President does the market get on Wednesday, on Thursday, on Friday, heading into the weekend?
And I'll add to that Pete Hegseth, the Secretary of Defense, has been speaking, and he's talking about how if Iran doesn't comply and doesn't come to any agreement, that the U.S. is only going to strike them harder and that strikes are ongoing. So that is the message coming out of the Defense Department at the same time that there's discussion about ending at the C-suite.
This month has been terrible, and I stress terrible for stocks and for bonds. Stocks down hard on the S&P 500, down 9% from the highs of late January, from the highs of the year. On the month, we're down by something like 8% on the S&P. In the bond market, bonds have done very little themselves. Bonds have actually sold off and yields have risen this morning. Yields are pulling back by some 2 basis points on a 2-year this morning to 380, down by 3 on 10s. How the story's changed in the bond market is intriguing. Just on Friday, something switched. This war's persisting. Crude is at triple digits around those levels. That persists. And this market started to think more about the hit to growth and less about what it might mean for central banks and the potential of them hiking interest rates.
Yeah, how much is this sort of a technical washout of all the people freaking out and selling positions that were misguided? And how much is this people really assessing a potential hit to growth, plus encouragement coming from Fed Chair Jay Powell that this isn't exactly a central bank looking eagerly to do anything, let alone hike rates?
Crude around triple digits. WTI this morning around 103. Brent crude around 107. The conflict in the Middle East whipsawing crude prices and creating uncertainty for global trade partners. Annmarie joins us from Washington now with a special guest. Hey, Annmarie.
Good morning, John. That's right. An individual who just met with a number of the U.S. trade partners at a WTO meeting in Cameroon is Ambassador Jamieson Greer, the United States Trade Representative. Ambassador Greer, good morning, and thank you so much for joining me.
Good morning. Great to be here.
So you just got back from meeting with a number of trade partners, and at the moment, global trade is upended by what's going on in the Strait of Hormuz. Did you have an update to give American trading partners about the flow of trade through that critical waterway?
Well, right now, I think the thing to understand is that the United States is generally insulated from a lot of the supply chain effects when it comes to direct commodities and things like that. For a lot of that, we have domestic sourcing. We have sourcing from our partners to the north and south of us and other places. But obviously, we're aware that this has an impact. In other countries, particularly in Asia, we know that their supplies are tight. And so we're watching that really closely. When I was meeting with all of them, this was not particularly high on their agenda of things to discuss with me because we were meeting for other reasons. But we're monitoring the situation, given that the supplies of commodities coming out of the Gulf can affect our trading partners in a lot of ways.
And it's not just crude; it's liquefied petroleum gas, which you need, especially in countries like India, to cook. It's fertilizer. Do you have a sense of a timeline?
Well, first of all, any kind of operation, you're focused on objectives, and you don't want to set artificial timelines. When I hear from the Secretary of State or the Secretary of Defense, they talk about, operations in terms of weeks. We hope that's the case. The Trump administration has made a lot of headway in its objectives in Iran in terms of destroying ballistic missiles, destroying the Navy, and making progress to make sure that they don't obtain a nuclear weapon.
You met on the sidelines with your Chinese counterpart. China buys the lion's share of Iranian crude. We have seen Chinese vessels given safe passage through the strait. Did this become a focal point of that conversation?
It did not. When I met with my counterpart, Minister Wong, the Ministry of Commerce Minister, this did not come up. We were focused on preparing for the leaders' meeting, which will occur in mid-May. We were talking about the WTO itself and the future of it, or potentially lack thereof, as the case may be. And so
lack thereof? You're thinking about getting out?
Well, I wouldn't say that. I would just say that the ability of the World Trade Organization to meet the needs of the moment, addressing structural imbalances, currency issues, huge export-driven surpluses by other countries. The WTO has never been able to address those things, and it won't be going forward. It can barely address issues on its current agenda.
So potentially you want a revamp of the WTO? Is that what you're calling for?
I will tell you that we have called for reform. The Trump administration has put in many proposals, concrete proposals about reform, about how to graduate countries to take on more obligations as they become more developed. We've talked about making sure that countries can adjust their tariff schedules to account for national core interests. And we put forward a reform plan together with a bunch of trading partners at a recent meeting in Cameroon. And there was near consensus on this. Countries like Brazil and Turkey eventually opposed the closing package, which is unfortunate. But it's also kind of exhibit A of how the WTO is unable to address these core challenges.
Back to the strait in your conversation with your Chinese counterpart. The president has been pretty direct to European allies. If you want the strait to open, you should also help us. Send vessels, send a minesweeper, send your Navy. If China is the one that's benefiting the most in terms of they're the ones that for years have been supporting this brutal regime, should they also not be on the hook to reopen the strait?
Well, listen, this is a decision for China, and I'll obviously let the President and Secretary of State and Secretary of Defense decide how they're going to align with other countries in reacting to the Strait of Hormuz closing. Again, it affects these other countries much more than it affects us. Other countries have been working with Iran to figure out arrangements to get out oil, gas, fertilizer, and all these other things. but it is clearly in the interest of the world community to make sure, not only to make sure that the Strait is open, but to make sure that Iran doesn't get a nuclear weapon, Iran doesn't empower its terror proxies in the region. The world would be much safer if the world was aligned on taking care of the Iran issue.
As you prepare for this trip, there's a lot of reporting that China, like Russia, is helping Iran, even when it comes to not just supply chains, but targeting U.S. troops. Is this going to be on the agenda when the president meets? Is this even potentially a reason why the trip could maybe get postponed?
In past meetings between the presidents, they've always talked about conflicts and hotspots. In the past, they've talked about Ukraine and Russia. They've talked about Iran. I assume that they'll talk about these things again. With respect to your question, is there going to be a delay in the meeting? I haven't heard talk about that, neither internally. I didn't hear that from my Chinese counterpart when I talked to him last week.
When it comes to the tariffs right now, there's Section 301 tariffs that you're looking into when it comes to China. And we've seen China actually have their own announcement that they're going to investigate U.S. companies. This tit for tat we might see in the trade between Beijing and Washington, back to where we're almost what it feels like a year ago. Do you think that's going to hinder the U.S. from getting back to the 20% level they were at before IEEPA was struck down?
I don't think so. When you look back to the Busan agreements, the agreements we achieved with the Chinese last year, we were seeking stability. We were seeking to achieve a level of tariff application on one side and a flow of rare earth minerals and things from the other side. Both sides want stability. Both sides want to see continuity. The Chinese know that the United States is trying to control for our giant trade deficit we've had with China for a long time, which went down by 30% last year, by the way. So I don't think it's going to...
Right, but China's imports to other countries into the United went up, and then those countries are importing to the United States. Don't you have an issue with transshipment at the moment?
So there's always been an issue with transshipment, but when you look at our shipments from third countries outside of China since April, right, since Liberation Day, that deficit has gone down by 17%. So while there may be some transshipment, overall our trade deficit is going down. It's going down with China. It's going down with the rest of the world. It's going exactly the right direction. At the same time, wages are going up in America. Productivity is going up.
Do you think you're going to get to the 20% level?
Well, I can't prejudge the investigations, right? It's Section 301. We have to go through the legal process. We have to collect information. It's quite public. It's quite transparent. We know what the nature of the deal is that we struck with the Chinese. So we will see. All I know is that the president, for sure, is going to keep protecting our economy. He's going to protect our producers so we can continue to have increased production in the U.S., increased wages here.
If China plays hardball, though, not just with their own investigations, but potentially bringing rare earths back into the foray. I know they have basically till October. There's a deal on the table. Potentially then, would you look to maybe decrease the tariff level?
Well, from our perspective, we're looking for stability. We're trying to we're trying to get the trade deficit reduced. We're trying to increase manufacturing in the United States, and we're trying to increase real wages. And all of that is happening. So we don't see a need to change our policy. The Chinese want stability. We want stability. I actually see a positive agenda with China going forward, where we learn to manage our trade with each other, where we pick the kinds of things we want to be selling to each other, things that are mostly non-sensitive to avoid some of the national security elements that prove challenging in negotiations. I see stability with China over the next year.
When it comes to this extension on rare earths, are you going to need one in October? Or will you think the United States is in a place where we don't need an extension?
Well, we've made a lot of progress. We have a few months, so I think we'll assess that down the road. We have Project Vault, where we're stockpiling a lot of critical minerals and rare earths. We have new projects in the United States to mine, process, and manufacture rare earths, including permanent magnets that we need for different motors. We're working with our counterparts and our trading partners, Australia, the EU, Japan, Mexico, to find projects we can do together to increase supply chain security.
How much will rare earths be on the table of this discussion with the president and Xi Jinping in May?
So when we met in Paris with our Chinese counterparts a couple of weeks ago, we talked about rare earths. The process with the Chinese is working fairly well. There are a few things here and there where we highlighted that we didn't feel like we were getting rare earths in a timely fashion, and we highlighted that to our partners. They took note of that and have it under consideration. So the presidents will talk about it if they need to. Our hope and expectation is that we're able to manage a lot of it between now and then at the staff level.
Do you think you're going to have to meet your counterparts again before the big leader meeting in Beijing?
I don't think we're going to need to do that, particularly. When we were in Paris, we reached general agreement on the types of outcomes we want for the leaders' meeting, and right now our deputies and our staff are in regular communication to try to land all those outcomes.
Can you give us any sense of what the main deliverables are going to be in Beijing?
I think that one of them, and there's been a little bit of coverage on this. We've been talking about a board of trade, a U.S.-China board of trade, which really will be a mechanism to help manage trade. Over the past 10 years or so, as the United States has tried to eliminate its trade deficit with China, figure out its export control situation, if we can formalize the mechanism a little bit to make sure that we can agree on things we are selling to each other. For the U.S., we want to be selling Boeings, we want to be selling medical devices, pharmaceuticals, ag products, things like that. The Chinese want to be selling things to us, and we're willing to buy things like, low-tech consumer goods and things like that, certain commodities that maybe the Chinese have that we don't. And so establishing that type of mechanism at the leaders' meeting and then going through a process of figuring out how to optimize trade with each other, that's going to be a big deliverable.
Ambassador Greer, thank you so much for your time this morning.
Thank you.
Jonathan, of course, that was United States Trade Representative Jamieson Greer. He is just back from meeting with his trade counterparts in Cameroon and, of course, looking ahead to this big leader meeting in Beijing between President Trump and Xi Jinping.
Annmarie, thank you. Thanks for the update. Great exchange. Let's give an update on news worldwide this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Iran is pushing the Houthis to prepare for a renewed campaign against shipping in the Red Sea. The move would be contingent on further U.S. escalation of the war. Leaders of the Yemen-based militant group are weighing options after already launching ballistic missiles at Israel. U.S. gas prices have officially topped $4 a gallon for the first time since 2022. The nationwide average retail price for regular unleaded gas rose to almost $4.02 a gallon. That's more than $1 since the start of the war with Iran. And NVIDIA announcing a $2 billion investment in Marvel technology. The two chip makers plan to collaborate on silicon phonetics technology, which uses light to move data faster and more efficiently. That's seen as key for handling the growing demands of AI and cloud computing. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate the update. Up next on the programme, Drew Pettit of Citi raising his outlook for crude prices. What does it mean for the stock market? Plus, Danny, how's your morning movers? Constellation Energy falling after disappointing on earnings. That stock down by close to 5%.
Right now, I think the thing to understand is that the United States is generally insulated from a lot of the supply chain effects when it comes to direct commodities and things like that. We're monitoring the situation given that the supplies of commodities coming out of the Gulf can affect our trading partners.
That was Jamieson Greer, the US trade representative, catching up with Annmarie just moments ago, setting the tone for this morning. This reporting for the Wall Street Journal. Check it out. Reads as follows. The president has told allies he's willing to end the US military campaign against Iran, even if the Strait of Hormuz remains largely closed. The president himself appearing to validate some of that with this morning, this statement. All of those countries that can't get jet fuel because of the Strait of Hormuz, like the UK, which refused to get involved in the decapitation of Iran, I have a suggestion for you. Number one, buy from the US. We've got plenty. And number two, build up some delayed courage. Go to the Strait and just take it. You'll have to start learning how to fight for yourself. The president then speaking to CBS, saying not much more has to happen to declare victory. So that's this morning. Compare and contrast that to yesterday, which is the complete opposite of the conversation this morning. This is what the president said yesterday. The US is in serious discussions with a new and more reasonable regime to end our military operations in Iran. Great progress has been made, but if for any reason a deal is not shortly reached, which it probably will be, and if the Strait of Hormuz is not immediately open for business, we will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants, oil wells, and Carg Island, and possibly all desalination plants. So the story Monday, completely different to the story on Tuesday.
If you're an analyst, what do? You do scenario analysis. Scenario one, they escalate and suddenly you're looking at $200 a barrel. You're looking at a much broader conflict. Scenario number 2 is an interesting one. If the U.S. walks away from the Strait of Hormuz, is that, okay, we can now de-escalate the prices in oil? Bespoke Investment Group said sometimes the headlines make you scratch your head. The U.S. walks away, oil prices continue to inflect higher. So, again, we have one thing, which is the confusion, and then another thing, which is how do you really navigate potential scenarios?
I wish I could, but I can't give you tomorrow's prices. I can't even tell you what's going to happen in the next hour. I don't know where we'll be at 4 p.m., but this is where we are at 8:49 and 54 seconds past the hour. Equity futures are higher by about 1% on the S&P. With your morning movers, Danny has more. Hey, Danny.
Hey, John. Some deal news between NVIDIA and Marvell Technologies. They're going to be teaming up with a $2 billion investment from NVIDIA for photonic silicon technology. Don't ask me exactly what that does. Something about fast data transfer technology that's important for AI. Either way, Marvell up 8.5% on the news. NVIDIA higher by 1.5%. Not necessarily because of this, but all of the Mag 7 having a pretty good day. Big cap tech doing well, too. Generally rallying, if we take a look at those, like you said, John, with the risk on sentiment that we're seeing, pinning itself to that Wall Street Journal story. So all of these stocks, the Mag 7 up at least 1.5%. Finally, we got some earnings from Constellation Energy. This is a company that has been struggling. The clean energy company components are getting more expensive for them, despite energy prices moving higher. It hasn't necessarily benefited them, and they missed on their earnings. Add to that additional capital expenditures, $3.9 billion in growth capex is what they're expending. So shares off almost 5% in the pre-market, John.
Danny Berger with the latest. Danny, thank you. Looking forward to the programme with Danny about 10 minutes away to guide you into the opening bell. Drew Pettit of Citi writing the following: the conflict in Iran likely gets worse before pushing Brent to 120 as a base case, bear case of 150. Joining us now is Drew. Drew, good to see you.
Hey, good morning.
Thanks for dropping by. This came out in your research. Basically, the S&P 500 is trading at our bear case multiple of 20 times and base case earnings estimate. What's the story of the month so far with that in mind?
Yeah, it's kind of broken up into a couple pieces here. On the cyclical side, you have kind of the input inflation side rising. So you're really worried about cyclical earnings, especially in the consumer where margins are tight and really the whole tariff story not going away. Then you have the secular stories not broken from a fundamental perspective. It's funny, like everyone's talked about software quite a bit. Earnings revisions up and to the right. Again, that's not the reason they trade down. Semiconductors up. Revisions up. I think Micron alone was maybe $6 to $8 in upside to index earnings on 320. So the secular is still working on the fundamental side. Cyclical and some of the defensives getting pressured. And what ends up happening, we're just trading the multiple around the macro circumstance.
Well, let's stay on the secular theme, the P, not the E. The appropriate multiple to put on some of these tech players now, and whether we've seen a structural shift because the nature of those businesses have changed.
It's more about the terminal multiple, not the today multiple. I've listened to a lot of guests kind of break this down different ways, but really, we don't know what's going to happen to software in the next, let's call it 3 years. What the market is trying to figure out is what is the margin profile of these companies in 3 to 5 years from now? And what's the exit multiple on that? That's why there's really severe sensitivity. So to us, like I think going into a lot of this disruption, let's call it like 6 months ago, you were pricing in 30, 35% pre-tax margins in software. The market, how it's pulled back, if you just assume that's all happening in the terminal multiple, they're really pricing in like 25% margins. So again, the sensitivity to software is that you have a lot of value out in the DCFs, and the market has tried to pull that back in. And now we get whipsawed because the positioning gets really light and momentum unwinds on a daily, hourly, minute type basis.
How much has the decline so far also been tied to a tightening in financial conditions and this sense that a company that comes to market with a deal may not find favorable pricing for themselves?
I would say that is showing up in the small cap move. So more so than in the S&P 500 move. I get it, quality is weakening in some of the software stocks. Think of like Oracle, for example. Everyone wants to talk about what's going on with CDS around Oracle. But in the small cap side, you're starting to price out the soft landing narrative, which was almost the base case heading into the year. You were going to have rates down. You were going to have credit spreads tight. Consumer was going to hold in. You were going to move past a lot of these cyclical softness and issues you saw. That was all going to be tailwinds for small cap. And we saw that in January. Now that's come in.
How much outperformance can you get if oil prices stay around this level in the United States, in U.S. equities?
I don't know how to really put a percentage or number on that, but we keep thinking about this as the U.S. is the best house in a bad equity neighborhood. So you kind of hear oh, we have supply. You just heard Jameson Greer talk about this, but we're not price setters on commodities. So while we still have supply, unlike Asia, maybe Europe, you might have constraints there, and that's a bigger headwind to earnings because it hits your top line, not just your margins. In the U.S., it's going to hit your margins, but you're still going to have the sales. You're going to have something to sell.
I'm pleased you've made that distinction because I know it's to state the obvious, but it hasn't been made enough over the last month. I keep hearing things like we're insulated, we create all this supply. It's true. There's not going to be a shortage problem in America. But you're not a price maker. You still have to take the prices that are on the international market right now, and the prices aren't good.
And it's going to lead to demand destruction on the margins, which is something that a number of companies have already mentioned. Key to watch how much demand destruction certain companies are already starting to see when they come out with earnings and their guidance.
Just quickly, 10 seconds. Happy to see the back of this first quarter.
Yes, might be able to sleep a little bit.
Let's hope. Drew, thank you, sir. It's good to see you. Drew Pettit there of Citi. Coming up tomorrow, Steve Orth of Federated, Tom Becker of BlackRock, Liz Ann Saunders of Charles Schwab, Nouriel Roubini of Roubini Macro Associates, waving goodbye to Q1.
Yeah, just wait for April. I mean, that's all I can think. Hold my beer, because that's how this year's gone.
Hello, Q2. We'll see you tomorrow morning, live from New York City this morning. Good morning. This was Bloomberg Surveillance.